I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief. Well, stock futures, they are poised to open at more record highs here this morning. The Dow set to open above 40,000, although we are seeing this slight move lower for Dow futures. Now, the move that we did see yesterday where we ended at record highs, that came after softer than expected inflation print, helping to reassure the street that a rate cut is still on the table. The S&P 500 closed above 5,300 for the first time.
I imagine they're getting those hats ready at the NYSE, the 40K for the Dow, and a fresh read on the labor market with jobless claims this morning. The number of Americans who applied for unemployment benefits last week that fell by 10,000 payrolls to 222,000, signaling the U.S. is still experiencing a low level of layoffs here. So let's get to over the three things that you need to know this Wednesday morning. Your roadmap for the trading day. Yahoo Finance's Jared Blickery, Brian Sazi, and Alexis Keenan have more.
Thank you, Brad. Stock futures are flat, but poised to open at record highs this morning. Major averages reached all-time highs on Wednesday, with the S&P 500 closing above 5,300 for the first time after CPI data came in softer than the month of April. But now that we have inflation pressures easing last month, the progress isn't likely enough to push the Federal Reserve to cut interest rates just yet, according to the bond market.
Plus, inflation-weary consumers are stocking up over at Walmart. Largest U.S. retailer reported stronger than expected first quarter revenue and same-store sales results, driven by a big jump in e-commerce sales and more visits to its giant hulking supercenters. Walmart also raised its full-year sales and profit forecast as consumers look for value and deals inside of a still uncertain U.S. economy.
And Meta under regulatory scrutiny again this morning. The European Union opened a formal investigation to probe if Meta violated EU child safety laws. The European Commission said Facebook and Instagram, quote, may stimulate behavioral addictions in children, as well as create so-called rabbit hole effects. The Commission also looking into the platform's age verification systems.
Our top story of the day, stocks in record territory. You can see a bit of a pullback here that we're looking at maybe ahead of the open, but we're right around the flat line, Dow 40,000. We're going to be asking strategists about this number all day, whether or not there's still time to buy and room to run here to the upside. You've got the S&P 500 closing above 5,300 for the first time. Nasdaq also here slightly moved to the upside. Now, this risk-on sentiment that we certainly have seen, or this move to the upside to record highs, comes on the heels of that better than expected, or maybe signs of softening here for the inflation printout yesterday morning. It was essentially in line with expectations. We did see an improvement here from the previous three readings, and because of that, that was enough here, Brad, for strategists to leave a potential rate cut here on the table, and as a result, we are pushing it to the upside. We did push the upside yesterday, so we're seeing a bit of movement here, just slightly to the downside ahead of the open. And as I flip this over and back to the major averages, this move lower, obviously nothing really to be too concerned about at this point, given the fact that we are right around 5,300 for the S&P 500. But again, just some key critical levels to watch in today's trading day.
Yeah, and we're keeping in mind here, of course, even with this hyper oscillation going into the open, where you're seeing the Dow, the S&P 500 trying to make up their mind, as well as the Nasdaq kind of hyper waffling coming into the opening cross. One huge thing to continue to monitor, of course, is the tenor that we're hearing over the course of this earnings season, how CEOs are talking about the economy, but also how the data is continuing to move. We had CPI this week, of course, jobless claims, which is really around a level that we had seen kind of be the normalization level of about 200,000 jobless claims pre-pandemic. So getting back to that and kind of maintaining at that level, that's key for the markets. That allows that to remain just a little bit more muted here in terms of triggering any type of outsized reaction. But there you're taking a look at some of the sector activity coming into the start of today's trading activity. Staples catching a bit here ahead of the opening bell as well by about 0.7%.
Yeah, certainly. We are also seeing some gains here in real estate and consumer discretionary. Utilities not too far behind. We've talked about this rotation into utilities, some of the names that haven't necessarily participated in the rally since the start of the year. So we've seen a bit of a rotation into some of those underperformers, relatively speaking, compared to the rest of the market. So it'll be interesting to see whether or not that trade continues there, whether or not there's room to the upside. And then energy and communication services here lagging by just a bit. But again, we will see where the market opens. And then obviously throughout the trading day, clearly lots of movement we'll likely see.
Well, we got some big movers here today. Walmart shares higher. Its first quarter results showing a nearly 4% jump in its U.S. same-store sales, fueled by a 22% surge in U.S. e-commerce sales as well. Yahoo Finance's executive editor Brian Sazi joins us now with much more on this. Brian, walk us through some of your takeaways here.
Well, Brad, I started to hyper oscillate in my chair after these Walmart results. I mean, this was a bang-up quarter, and I think the Citi team is right on the mark here. New note from their team out a couple minutes ago saying this was another positive quarter from Walmart, and the winning streak continues. Walmart shares up almost 7% in the pre-market. This quarter is totally 1,000% deserved in terms of this stock pop here. The U.S. business, as you mentioned, same-store sales up 3.8%, but these are not the real stories of this quarter. It is double-digit e-commerce growth in Walmart U.S. International, Sam's Club, check done. Next, the international business has finally started to turn around. It's a story nobody on the street is talking about. A lot of our competitors aren't talking about it, and it's one that I'm going to start digging into personally because I think that international business is really starting to drive a lot of big results at Walmart. Nobody cares about it, and they really should. And then lastly, inventory has really started to come down at Walmart. This has been a big focus for this company for more than 2 years. Inventory declined in the U.S. That is allowing them to reduce markdowns in their business and push up profit margins. Overall, I'm really trying to figure out, guys, what is the state of the economy if Walmart is doing so well? And I think that old thinking, economy slowing down, Walmart does good, I think that's totally broken. I don't think that applies anymore. I think this is a retailer now attracting all sorts of consumers. Walmart slipped in there really for the second straight quarter. Higher income households are going to Walmart. Why? Because they're not selling crap anymore. They're selling higher end goods, better fish, better meat, better products, better protein shakes, whatever it is. This is not that same clunky, horrible shopping experience as it was 10 years ago.
You know, Saz, it's so interesting and it's important to point out, and I'm curious because you mentioned the international component here potentially being a driver, likely a driver here ahead for Walmart. Is that also consistent with what we're seeing overseas just in terms of more high-end shoppers when you take a look at Europe, when you take a look at other places, also trading down to Walmart as well?
Well, some of the luxury good retail earnings over the past few weeks haven't been that great. Yeah. I think just Walmart is just operating its business better. So it's Walmex. That's their business in Mexico. Walmart China doing very well. Some of the big box supercenters that they own, I believe Sam's Clubs in China is doing pretty well. And then in addition to that, or in part because of this international turnaround, you're seeing Walmart out here come and raise their guidance for sales and profits for the full year, despite, keep in mind what that full year guidance entails. That captures the election. You know, what does this business look like a month before the election? Do consumers pull back? Unsure, but this is Walmart saying, you know what, we're pretty confident what the consumers are going to do. This is what our data is saying. We're confident they're going to be spending throughout the election into the holiday season.
And it's how they're classifying the consumer that they're monitoring over the rest of this year too, and saying in this earnings report, especially pointing to that guidance that you were just mentioning, that they're expecting the consumer to be generally stable. We've seen this move from resilient to healthy to now, from Walmart's purview, generally stable, and a question of what that stability means, and in terms of this normalization that we're starting to hear increasingly among retail CEOs right now, what that means for certain aisles that Walmart operates as well.
Right, and one finer point than you always talk about is the advertising business inside of Walmart. Strong gains really underscores why Walmart is out there buying Vizio. This has turned into a pure profit center, this advertising business for Walmart, and of course Amazon. Next up, and another topic we have to dig into, membership fee income for Walmart. And it's not just Sam's Club anymore. It looks like they're starting to have some real success with the potential Amazon Prime killer in Walmart Plus. So that looks to have gained traction too. Nobody's talking about it. They should be.
All right, Saz, thanks so much. And of course, we're going to continue this conversation right here on The Morning Brief. We will be joined by Walmart CFO John David Rainey and Sazi as well. That's coming up 9:15 a.m. Eastern Time. All right, another stock that we are watching this morning is Meta. You're looking at some pressure on shares, off just about 1%. Now, the company coming under some pressure after the EU announced a formal investigation into Meta's Facebook and Instagram platforms. The regulator concerned about child safety on the platforms, violations of the use of online safety laws coming with hefty fines. Yahoo Finance senior reporter Alexis Keenan has the story on that for us. Alexis.
Hi, guys. Yeah, so another investigation into Meta's Instagram and Facebook on the other side of the pond here. They're looking into the EC for the EU if the companies violated online content rules for kids. And this is specifically the Digital Services Act that went into effect last year. So kind of testing a bit of this new law on this round. Now, what the EU is saying is that they're concerned about three different things in particular. One is that the platforms and its algorithms may stimulate these behavioral addictions in children. They say they're worried they create a rabbit hole effect. And that's basically basically content and algorithms that works to so individually target and whoever is using it that they kind of reinforce and have the ability to reinforce harmful impacts on children. They're worried. They also say that Meta's age verification processes for kids, which are supposed to not permit children to have a regular access, full access to the platform outside of age 16. In some countries, it's 18. They're worried that the company is not compliant in those areas. Now, one of the commissioners for the EC said they're not convinced that the company has done enough. The company is required under these European laws to submit what they're doing to mitigate these potential problems. They did that in September. And what the EC is saying here is that they're not sure they're compliant to mitigate these negative effect potential risks. Now, in response, Meta told Yahoo Finance, we want young people to have safe, age-appropriate experiences online and have spent a decade developing more than what they say are 50 tools and policies designed to protect them. They say this is a challenge that the entire industry is facing, not just them. And they go on to add that they have parental controls in place. But look, guys, the fines here for violations, if they are found at the end of this probe, they are hefty. They can run up to 6% of annual revenues for the company. So if we're looking at Facebook, or Meta rather, is 135 approximately billion in revenue for fiscal 2023. We're talking about $8 billion here. So in the EU, the fines are very, very serious if violations are found.
Yeah, and they've tended to have a more kind of outsized dollar figure, or just figure in general in terms of the compensatory damages there as well for U.S. companies, as we've seen in the past as well. Alexis, thanks for breaking this down.
You bet.
Appreciate it. Coming up, everyone, a C-suite roundup. We'll hear from Walmart's CFO, John David Rainey, after the company saw strong sales growth in its first quarter results. Plus, the chief financial officer of Dow Inc. will join us from the floor of the New York Stock Exchange ahead of the company's Investor Day. You don't want to miss that.
Walmart shares gaining just about 6% in pre-market trading after the company reported very, very strong results. E-commerce sales fueling growth during the first quarter. The retailer now expecting its full-year net sales growth to hit the high end or slightly top its previous forecast. We have John David Rainey, Walmart CFO, joining us now alongside Yahoo Finance's executive editor, Brian Sazi. John David, it's great to have you here. Thanks so much for making the time for us. So let's talk about what was yet another strong quarter here for Walmart. You've got shoppers clearly prioritizing value. I'm curious what your read right now is on the consumer and some of the trends that you're seeing here in the current quarter.
Well, it's great to be on the show first. Thanks for having me. We are really pleased with the results this quarter. Grew the top line 6%, grew operating income over twice that amount at 13.7%. And I really think it shows that customers are continuing to come to Walmart for not only just value, but also convenience. In terms of the consumer has been relatively consistent. We are, like everyone else, is looking for if there's something there, something that we should be more aware of, but they've been pretty consistent quarter to quarter here. We see that wallets are still stretched. They're still looking for value. They're still using discretion with buying those higher income items. I think notably, retail sales came out yesterday showing April was relatively flat. We think when we look at our business that that's largely the result of the Easter shift year over year from March to April, or April to March, I should say, and also weather impacting the month as well. So when we look at the quarter in total, as well as what we see in the first few weeks of May here, it's been relatively consistent.
John David, good to see you again. Appreciate you coming on.
Hey, Brian.
I really do think that investors are misunderstanding what Walmart is today. You know, I still think they think Walmart is a place to get cheap goods, and maybe not everybody goes there. And then there's that component. But the other component is just how much of a tech company the company has become. Do you think they understand, how much value tech is driving at Walmart right now?
Yeah, there's so many examples, Brian, where we're using technology to help our customers and help our associates that are really leading edge. And one of the examples I like to point to is the Scan and Go app that you have when you shop at Sam's. Fully a third of our customers are using this experience when they shop with us, where they're checking out with their mobile phone. I don't know the data on this, but I would stand to believe that there's not many other examples of a digital experience in store that has a higher penetration than that. And so we're really excited about that. But there are many, many examples of where we're leaning into technology to help not only our customers, but also our associates. In terms of how that translates into our financial results, we had roughly $1 billion increase year over year in our operating income. Fully a third of that came from these newer businesses like advertising, like membership, like data ventures. Data ventures grew 100% year over year. These are all higher margin businesses that are going to continue to help our margins go up over time.
Where do you like to reinvest those margins into the business?
Yeah, well, first and foremost, in helping the customer have better experiences. We're always looking to be an advocate for our customer, whether it be low prices or better experiences. But we have a lot of opportunity in our fulfillment around supply chain. We've invested a lot, and we'll continue to invest a lot in automating our supply chain. And that's not just robotics, it's also software and technology. That helps us to better distribute our goods and merchandise to our stores in a more seamless fashion and in a less expensive way over time. And that translates into less e-commerce losses, and hopefully we'll get to a point where we see e-commerce profits. One of the things I talked about on our call this morning that I am really excited about are the incremental margins in our e-commerce business. And what I mean by that is for every additional dollar of revenue that we had this year, how much of that fell to the bottom line? So in a business overall that is, call it roughly a 4% margin business, the incremental margins for e-commerce for us for the quarter were 12.5%. So roughly 3 times the overall margin for the enterprise. And so you look at that, and to me, that's a very compelling point that our margins are just going to go up over time as we continue to grow these higher margin parts of our business.
There continues to be just this focus in this country about inflation, where it is, where it isn't. Consumers, despite the Dow breaking through 40,000, 15 million plus jobs created over the past 4 years, households don't feel wealthy, in large part because of inflation. Are you seeing inflation slow down, and do you see any signs of disinflation where prices are going to decline at any point this year and ease some of the pressures on households?
Sure, Brian. So overall, if you look at the basket of goods that we sold in the last quarter, inflation for us was about 40 basis points. And so the takeaway there is that all of the revenue growth was driven by units, by foot traffic. And so we're really pleased about that. And it shows that customers are really coming to Walmart. Within categories, not only do we see disinflation, we see deflation in general merchandise. It's been that way for a couple quarters. Food and consumables are, call it roughly 0 to 1% up. And so when you look at PCE or the CPI print, it's really shelter and energy, which is driving 70 to 80% of the increase in inflation. If you focus in on food, I think there's a further disparity between food at home and food away. That gap between the two has actually grown by 20% over the last 5 years. It's 4.3 times more expensive to eat out than it is to eat at home right now.
John David, going off of that, I was looking at the quick analyst reaction to your print out this morning, and I saw him mention a couple of times that one of the challenges here for Walmart, once inflation starts, what you were just talking about, is the ability here to retain some of the new customers that you have won over the last several quarters. What does your strategy look like for that?
Yeah, well, first and foremost, I'd say convenience. We've been a company that's been known for low prices for 6 decades. We're now being known for convenience, and convenience matters to any household, irrespective of your income level. We continue to see progress in e-commerce that grew once again over 20% for us this quarter. But it's not just customers that are shopping with us online and then going to the store to pick it up. The last 2 months, we've actually seen delivery outpace store pickup. And if you look over the last 12 months, we've shipped 4.4 billion items in the same day or the next day, and over 20% of those have been within 3 hours.
Just lastly, and we only have about 30 seconds left here, you're monitoring the data as well as we are on the economic side, and whether that be retail sales or CPI, we're looking at some of these department stores that are flailing right now and trying to figure out what their strategy is. How much share do you think you can take from them as they're trying to figure out what their next iteration of growth is, and how do you retain some of those customers you might be able to pick up?
Well, I think there's a couple points to focus on here, and I don't know what other retailers are doing. We're focused on serving our customers the very best way that we can. And if we do that well, if we execute well, I think we'll continue to see share gains. The other point is I think you're seeing how an omni-channel model resonates with customers. It's one thing to have an e-commerce site that's really good. It's another thing to have a brick and mortar site that's really good. But combining those two is what's resonating with customers. And we're seeing that in our results.
John David Rainey, who is the Walmart CFO, alongside Yahoo Finance's executive editor, Brian Sozzi. John David, thanks so much for taking the time here.
My pleasure.
Certainly. Companies are doubling down on growth strategies in 2024, and Dow Inc. is one of them. The company announcing further plans to deliver on its strategic vision, financial targets, and climate projects as well during its Investor Day today. Shares are up over 7% so far in 2024. For more on this, let's bring in Jeff Tate, Dow CFO, joining us from the New York Stock Exchange. Great to see you here this morning, Jeff. You were at Dow many, many moons ago. You're a boomerang to the company here. So you've seen this company over many iterations. What is the core difference between Dow now versus what it was back in the 90s and even early 2000s?
Good morning, Brad. It's awesome to be here with you today. And you're right, I am a boomerang, but it's been so exciting to be back at Dow for the past 6 months or so. And from my vantage point, Dow has never been in a stronger position, both financially as well as operationally, Brad. When I look at our ability right now to be able to prepare for growth in this upcycle that we're looking to see here, we could not be in a better position to do that. And I think it starts with our culture. It also goes along with our financial position. Our balance sheet is the strongest it's been in decades, and we've got the innovation pipeline that surely positions us well for that future growth.
Jeff, talking about that future growth, I'm curious just what you're seeing from a macro perspective, some of the challenges out there right now, how you're navigating those headwinds here at Dow. And as we talk about the fact that we could be in this high for longer rate environment, what specifically does that mean for your business?
Well, for us, we've got a very diverse portfolio, and one of the things that serves us well is not only being diverse from an application standpoint, but also diverse from a geographical perspective. What we're seeing right now, certain areas are really strong and resilient, such as infrastructure electronics. So you think of data centers, you think of AI support. Pharma continues to be strong for us. Packaging has been resilient throughout for us over the past 2 years and continues to have strong export performance as well as local performance. Now, there are some areas that are still challenged, as you mentioned. For us, those things that are more interest rate sensitive, such as housing, looking at appliances, furniture, those spaces for us are still relatively soft and relatively slow. But again, having that diverse portfolio for us has really served us well in working through the cyclicality of our industry.
Jeff, it's been an interesting time to hear about some of the ESG investments that companies are making because investors are trying to figure out when that will ultimately pay off. Investors are also going to hear Dow talk about some of those climate initiatives today, and they're going to have to wrap their minds around what it means for a company to either prioritize eradicating emissions from operations that could have a financial impact versus purchasing offsets. How is Dow approaching that?
We're approaching it as the power of and, Brad, A&D. For us, we're going to do both. We're going to look to decarbonize. We're also going to look for profitable value creation. And as an example, our Path to Zero project at Fort Saskatchewan, Alberta, is a significant example of that, where we're going to have the first zero emissions major ethylene and derivatives complex in the world. And in fact, in November of last year, we actually got the final investment decision. And this will be an opportunity for us to take full advantage of the ethane advantage that we have in Canada today. We're going to build this facility on an existing Dow site, so the infrastructure costs will be much lower. We also have a great opportunity today in which we're doing this to lock in a lot of the ethane requirements that we'll have. We're locking in long time lead equipment, and we've already been able to hedge 100% of the currency that's associated with this. So we're mitigating a lot of those potential risks that you can have as we focus on not only decarbonizing, but more importantly, creating that value.
And understanding where some of those operations are taking place, U.S. versus other parts of the world, as you were mentioning in Saskatchewan, we have to think about, of course, the other risk that's out there in a general election year, how you could see a changing of the guards in D.C. and what that would mean for a lot of companies who have prioritized some of the goals that you just laid out and where that could have another financial implication for the company. How are you kind of monitoring that and gaming to mitigate that risk?
Well, what we look at is that, regardless of who wins from an administration perspective, Dow feels like we're well positioned, Brad, to be able to operate effectively, operate profitably, but also be able to meet our sustainability targets that we've set out there, which one of those is to be net zero carbon emission and carbon neutral by 2050. And so as we look at the investments we're making, not only in the US, but around the world, we're well on our way to making progress in that space.
Jeff Tate, Dow CFO from the New York Stock Exchange there. Great backdrop. Great to see you here this morning, Jeff. Thanks so much for taking the time.
Thank you.
Another stock that we're watching today is Chubb, shares of the insurance company. They're jumping, as Destiny's Child would say, by about 6%. And this is after Warren Buffett's Berkshire Hathaway revealed that this was the secret stock pick that the Buffett team has been betting on in a new regulatory filing here. They're seeing shares, as we mentioned, jumping. They are also higher over the course of this year, last I checked, as well for Chubb. But of course, a lot of mystery to know what Warren Buffett is investing in the business of moats. You're seeing the year to date up by about 12%.
Yeah, the suspense over now here. And we want to point out that clearly this isn't a huge surprise given the focus that Berkshire Hathaway has on the insurance business, given some of the commentary when I was out at the annual shareholder meeting just 2 weekends ago, just the upbeat commentary that him and his executives had when it comes to the insurance business and the focus that is going to be here for Berkshire going forward and where those opportunities lie within their portfolio. So I think what's also important to point out here is that this is relatively unusual to not reveal the identity of a stock in one of your holdings here, at least for Berkshire. And the last time they did this was 4 years ago when you take a look at the holdings that Berkshire had in Chevron and Verizon back in 2020. So I think the mystery, the suspense surrounding this really gained a lot of attention. The fact that he was not asked about this at the shareholder meeting a couple of weeks ago was a bit of a surprise. I was hoping to get a little bit of commentary there from him. But the fact that we are getting this now and the fact that it is Chubb just really shows that Berkshire is remaining committed here to some of their focus that we have seen clearly at Berkshire over the last several decades. And the fact that they think that Chubb is well positioned within the space, given their margin expansion, given their underwriting margins are so strong, and they have seen solid growth here over the last several quarters.
Yeah, and in the insurance businesses that they've consistently had exposure to in the past here, of course, Geico being one of the largest holdings that has really gained a lot of traction or fanfare after Berkshire Hathaway took a stake in that, and also thinking about the CPI numbers that even came out showing where inflation still is and isn't. I actually posted this to my Instagram yesterday, and I was surprised at how many friends slid in my DMs afterwards and were just like, auto insurance is crazy right now, dude. It's absolutely insane. And Berkshire has exposures to multiple types of insurance businesses. And so Everybody is keeping tabs on when insurance premiums are going to start to recede a little bit here. But for Berkshire right now, there's so much that gets factored in, whether it be the parts that go into different parts of the insurance business here, when you've got to make sure that a claim that's submitted is able to be serviced upon, or even the wages that go into making sure that the servicing is done properly. All these things considered, I think that's where Berkshire has made its really concerted play. And also, of course, it's a business of floats as well.
Yeah, exactly. And also within the shareholder letter that was just released recently, Warren Buffett saying that property casualty insurance providing the core of Berkshire's well-being and growth. So again, goes back to the priority for this business here and where they are placing those bets going forward.
All right, it's time for our daily game of Who Rang That Bell? Of course, the famous line from The Wizard of Oz. Farmer Mac rang the opening bell at the NYSE, and Insight Partners ringing the opening bell at the Nasdaq. Hey, it's 9:30. Let's do a quick check of the market, sponsored by Tasty Trade, why don't we? Taking a look at the Dow, the S&P 500, and the Nasdaq. Oh my gosh, all right, slips just below 40,000, but we're still in positive territory here for the Dow. My goodness, we were so close. We were right there, a hair's breadth, some might say, away from opening in that 40,000 marker. We'll see exactly where that opening cross was in a moment. But the S&P 500, you're seeing that flat just barely to the upside, and the Nasdaq Composite that's flat just barely to the downside here as well.
Certainly, we will keep an close eye on those record-setting numbers, whether or not we're going to see another day as we could potentially close at all-time highs. Walmart, the big driver of the Dow here this morning. The reason why we're still looking at gains here. All right, let's get over to Jared Blickery for a closer look at this movement that we're seeing. Jared.
Yes, I thought we'd start off with some records, but we know the S&P 500, the Dow, NASDAQ, all at or near record highs. But I want to show you the Wilshire 5000. This is an index that's supposed to represent all of the liquid stocks in the U.S., and we don't have as many stocks as we used to, so it's actually 3,500. But we have just notched a record high in the Wilshire. So all the arguments about the breadth of this market are just evaporating one by one. Also want to point out the VIX is near the lows of the year, so seasonality actually favors a higher VIX over the next 2 weeks. That is the only potential headwind I see for this market, especially after clearing CPI yesterday with flying colors. Here's our sector action. We got staples and financials in the lead. Financials, by the way, at a record. JP Morgan and Goldman Sachs driving that. But I do want to get to our meme stocks here while I got some time, because we have seen GameStop under pressure in the upper right. It's down 12-13% right there. And AMC at the bottom there, that's about 5%. Let me show you the two-day totals here so you can see what happened. I'm going to sort by performance, and you're going to see the biggest losers were GameStop, AMC, and Cost, all down about 25%. These guys have been moving somewhat in lockstep, but now let me show you the four-day total where, guess what? Reversal of fortunes. We have GameStop still up 100% on the week, basically. AMC up 76%, Costs up 44%, and then you can go down the line. The point is, it's actually been a successful week. If you're a buy and hold meme stock, if you're just a trader, you got to be nimble, because these guys have been flying high and low. So let me just see if I can pull up a GameStop chart. Here's the four-day price action, and you can see they're still up 92%, but pretty far, at least 20%, I believe, off of those highs.
All right, Jared, a trade that we're going to continue to watch here today. Expected lots of volatility. All right, Jared Blickery, thanks so much for breaking that down for us. Well, major indices hitting record highs this week. We're going to have more on that, whether or not there's still upside ahead for the broader market. We'll be right back. Well, stocks hitting record highs this week after the inflation data print out yesterday morning came in line with expectations, reigniting some of that optimism that we have seen on the street that we could see a rate cut before the end of the year. And taking a look at where things stand today, you've got the S&P holding on to positive territory, pushing further above that 5,300 level. You've got the the Dow, just below 40,000. We, of course, are going to monitor that and see whether or not we can reach that level. Here to tell us more on where the markets are headed, we want to bring in Kevin Gordon. He's Charles Schwab Director and Senior Investment Strategist, here to break it all down. So, Kevin, I'm curious, how are you looking at the levels that we're currently trading at, and whether or not you do still see some room here to the upside?
I think there's room to the upside, but I think more important to keep in mind is what's going to get us there, number one, and then number two, kind of what to expect, and maybe paring back the expectation of really strong gains, akin to what we've seen if you go back to last October, when we really got this leg higher after that correction. And I say that because, so much focus this earnings season has been on companies, for the most part, at least for the S&P 500, different story down the cap spectrum, doing relatively well. But in our mind, when you look at the data and you look at the outperformance for companies relative to the S&P or whatever benchmark, even when they're beating earnings, there hasn't been outperformance. You've actually seen an average decline of 0.2%. So when you factor in sales and there's a beat on sales and earnings, that's when you've gotten strength. But when you start to look at where we are now in the earnings cycle, now you're moving back into double-digit territory in terms of earnings growth. That's actually a weaker zone. You're still seeing gains, but historically a weaker zone for the stock market. The strongest zone is when you're between down 20% and up 5% for earnings. So we've already exited that zone. Now we're just moving into something that's a little bit more, consistent with maybe relatively, less strong gains, I would say. But you're not in negative territory. So that's the one thing. The second thing being what you mentioned about rate cuts. I'm not sure that we should put so much emphasis or so much focus on the Fed cutting being necessarily a bullish or a bearish thing for the market. It really matters more as to why they're cutting, what the economic environment looks like, because if they're cutting for the wrong reason with unemployment surging and the labor market deteriorating, that wouldn't be a risk-on scenario for the market.
And so you mentioned that even if companies are beating, they're still not being rewarded as much as we've seen in the past. So that would almost kind of spell out this hyper Goldilocks scenario that we could be navigating through for the rest of this year, even leading up to the election in November as well here. Yeah. How would you evaluate that? And what have we typically seen in those types of environments?
Well, I think it speaks to what the focus has been on the part of the market, where if you're beating on earnings and if you're achieving really strong earnings growth and in a profit scenario just based on aggressive cost cutting, that's just not good enough anymore for the market. So you're at the point in the cycle now where you need to start seeing actual sales growth and revenue growth improve, because we've been in an environment of decelerating revenue growth, still positive, but the change has been sort of moving lower. So as long as you start to see that improve in the back half of this year, which we would expect to be the case, then you can get another leg higher in the market. But you need to see both of those come into play in addition to strong guidance. That's another key area where we haven't seen as much strength on the part of the market's reaction as if a company's revising guidance to the downside. That's been to the detriment of the stock price.
Kevin, what about the fact that we've seen some of these defensive sectors coming into favor when you take a look at the fact that consumer staples, utilities, both trading above their 52-week highs? Is that a bullish sign for the market, or is this something that maybe investors would be looking at a bit bearish?
Yeah, I think the natural, maybe human reaction is to look at something like utilities and staples, the strength you've seen there, especially leading this next leg higher, mostly for utilities, not as much for staples. But the breadth has still been strong for both. But the natural reaction would be to say that that's a bearish indicator. It's hard when you look back in history and look at these prior episodes of markets reaching new highs or doing well with the defensives also doing well and say that that's a bad thing. You have one instance being the lead up to the global financial crisis, but that's a sample size of one. And I also think that when you look at something, especially like utilities, a sector that got deeply oversold back in October, we have to keep in mind that relative to the S&P, for the utilities low in October of 2023, relative to the S&P, you hit an all-time low. And then in absolute terms, the sector fell to a 3-year low. Very unusual to see in the first year of a bull market. So I think that part of the strength that you've seen can be attributed to the fact that that sector just got deeply oversold and people are now buying into the momentum.
And so with that, how much momentum is there left? I mean, we're looking at, looking over your shoulder, 39,918 for the Dow right now. All of us are just waiting to whip out the 40K hats at this point. But how much more room to run from there are you anticipating?
Well, it depends. I mean, if you're talking about momentum as a factor, we went through a pretty swift contraction because when you look at that late March to mid-April period, the mini pullback, if you want to call it that, not a full-blown correction for the S&P. But what was leading that were some of the momentum names that had been in that spot and dominating the momentum factor since late October, early November. So if they get put back in and then you continue to see momentum outperform, it's understandable as to why that could lead you higher. Especially if now what would be interesting is, given the run you've seen in utilities, if some of those names and some of those industries now start to move into momentum, because momentum as a factor is not just tech or communication services. It's just whatever's been doing well. So you can easily swap in another sector and see momentum as a factor continue to do well.
Kevin Gordon, Charles Schwab, Director and Senior Investment Strategist. Thanks so much for taking the time here.
Good to see you.
Good to see you too.
Thanks.
Well, Cisco shares, they are higher in pre-market trading, and now that trading has commenced, it's down by about 1.5%. After the tech company, they had topped fiscal Q3 earnings expectations, plus raised the full year revenue forecast. In spite of the beat, sales dropped 13% during this quarter compared to last year. Cisco saying Splunk, its recently acquired software subsidiary, will be a catalyst for further growth here. And so one of the huge things, as I was looking through this earnings call transcript, I didn't have a chance to listen into this one yesterday, but it's all going to continue to come back to, and I mean, stop me if you've heard this before, but the amount of AI mentioned seemingly a company is able to weave into their demand narrative going forward at this juncture. And Cisco attempted to do just that as well here. Even with the speed on the top and bottom, I think there's still a lingering question of how accretive that will be to the business in a near-term period of time for a lot of investors out there.
Yeah, and taking a look at the analyst reaction here, a lot of focus here is coming on their analyst day, which is going to take place next month in June 4th. That could be the next catalyst here for the stock going forward. But you're right, Brad, to call out AI. I think that's one of the bullish thesis here when we talk about this stock and why so many people are seeing reason to buy, at least at this point. It's also important, though, to point out that Cisco has been an underperformer since the start of the year. When you take a look at that year-to-date chart here, we have it up on your screen. It's actually declining about 2.8%, nearly a 3% drop here since the start of the year, and that's compared to the S&P 500's 10, 11% climb that we've seen since January 1st. So I think a lot of people are looking at this name and seeing that we could potentially look at some upside here for Cisco. When you talk about the spend that companies are allocating towards AI, when you talk about the spend that they're allocating towards cloud, and that was enough to give that upbeat fourth quarter forecast. But when you take a look at the underlying factors right now, there still is some weakness surrounding Cisco stock, and that's a big reason why you're looking at shares off just about 1.5% today.
Yeah, absolutely. And investing a lot right now in terms of where they're seeing the demand, whether that be on customers who are investing in private data centers, collaboration, they're saying that's being positive, but also even in the security realm here. So I think this an era, and this has kind of been one of the underlying themes of this earnings season, where companies are spending because of the demand that they're seeing in order to scale up to continue to deliver at scale, I should say, for a lot of the customers that are asking them for many of the services, in this case for Cisco, the cybersecurity element, the, of course, cloud element, but then the data center and AI weave in as well. There's spending that happens on the front end for Cisco in order to realize more of the long-term contracts from their portfolio clients. Also coming up, everyone, we saw strong results from Walmart's first quarter release, and Target results are still on tap. Next week, we'll speak with an analyst who still says Walmart is still better positioned. Next.
Walmart seeing strong e-commerce sales during the first quarter with its delivery business volume surpassing in-store pickup. We spoke with Walmart CFO John David Rainey about the state of the consumer, and here's what he had to say.
The consumer has been relatively consistent. We are, like everyone else, is looking for if there's something there, something that we should be more aware of, but they've been pretty consistent quarter to quarter here. We see that wallets are still stretched. They're still looking for value. They're still using discretion with buying those higher income items.
We want to bring in Oliver Chen. He's TD Cowen's senior research analyst. Oliver, it's great to see you. I'm curious just to get your reaction to what we just heard from John David. And if we are seeing the consumer still willing to spend, although we are seeing some pressure, what in turn does that ultimately mean for Walmart here in the coming quarters?
Yeah, Shauna, Walmart's our top pick. It's great to be here with you. What Walmart offers is both needs and wants. So on the needs side, grocery remains critical, also offering the consumer extremely great value. What we see is a bifurcated consumer, a pressured consumer at the low and middle end, and a consumer who's balancing more expensive needs, but still wants other items. General merchandise, non-food has been a little bit bumpier, but keep in mind, Walmart is the country's leading grocer, and over 50% of the revenue is related to food. So it's a bit mixed. Bottom line, a consumer is under pressure, so there continues to be cautious optimism.
In terms of the rewards programs that are out there, Oliver, I mean, Walmart offering its rewards program for members. You've got Amazon that they're going up against as well with their very noted Prime membership. And then, of course, other entrants into the space, whether that be the behemoths that are kind of the legacy buy in bulk of BJ's and Costco. But then, you know, there's also Target, of course, out there. So all of these things considered, where is the best bang for a consumer's buck when it does come to some of these membership programs?
Yeah, what customers love about Walmart Plus is gas. And Walmart Plus is this entire ecosystem of delivery specials, as well as Paramount and media. And Walmart is a big part of Americans' lives, just given the sheer footprint of 4,000 stores. 90% of the US is within 10 miles of a Walmart. So it's a very trusted brand, and Walmart Plus has had great momentum. As we think about artificial intelligence, technology, Walmart being a tech company, this membership model, the marketplace model, and digital advertising, all of these really work together. Brad, the other marketplace in terms of membership model that we really like is Costco. And Costco, in many ways, is not even a retailer. It's a membership club where most of the profits are due to that fee. So we see this evolving, but it will increase in competition, and it's very hard. These programs need to have multifaceted value.
Oliver, what about the ability here to retain some of the new customers that Walmart has won over the last couple of quarters? Are you confident they will be able to do that, and why or why not?
Yeah, Shauna, we're excited about that. Higher household income customers have been coming to Walmart, in part because of the convenience, the speed, and the customer satisfaction. So enabling marketplace, having products like Apple, fragrances like Burberry Goddess, that really elevates Walmart as a whole. And then having curbside pickup, you don't have to go in the store. Adding convenience has been a big factor, as well as being clean, fast, and friendly. So executing on both. And all consumers appreciate low prices. So this whole ecosystem is working. And when you do experience curbside pickup, your net promoter scores are high, you recommend it to others, and you do come back.
Oliver, I mean, you're a very fashionable person. We talk about this all the time. We see it all the time as well here. You've seen more of these collaborations between companies like Target and Diane von Furstenberg, and making sure that they're kind of showing that higher end consumer as well that, hey, those same brands, those same manufacturers or fashion houses, we have the ability to partner with them too. What does that look like for some of the Walmarts, the Targets of the world, in order to make sure that they are, to Shauna's point, retaining that higher end consumer even after we see a much rosier macroeconomic scenario?
Yeah, Walmart's making big strides in apparel. The problem is Walmart does a great job with basics, such as underwear and basic apparel. The opportunity is for Walmart to be more like a lifestyle brand in apparel and expand into dresses, amplify their presence in denim, and trade the customer up. We see a lot of innovation in the new store remodels, as well as brands they're adding to their portfolio, as well as private label. So looking ahead, that should be really exciting. We also see what we say is customized moderation, meaning customers are both scrimpling and splurging, trading up and trading down. So today's customer goes high, goes low in a really unique way, and everybody wants to look good and fashionable, and you can do that at a very good price. And the other category we've always loved is beauty. Our favorite ideas are Ulta and e.l.f., and beauty is about investing in your face and body and wellness and essentials. Walmart and Target have big opportunities there as well. So overall, we're excited about the journey ahead. And Walmart, as you think about it more broadly, social media, short form video, having their own movie during Christmas time, this will continue to build Walmart as a lifestyle brand as well for younger customers as well.
I mean, is that movie during Christmas time more Hallmark Channel, or is it more, box office type of picture there, Oliver? I think that's the question that a lot of potential viewers want to know.
Yeah, I think they've struck a really good balance, and it's exciting.
Yeah.
Lindsay Lohan, Mean Girls, some great commercials, some great rethinking about how they position the brand. That's fun, fast, friendly, convenient, tech-enabled. All these factors, are something Walmart's considering as it continues to modernize. Yet still offer just great prices, great grocery, great execution, and balancing this, as the customers evolve at large.
Oliver Chen, TD Cowen Senior Research Analyst. Oliver, always a pleasure to see you and get some of your insights. Thanks for taking the time.
My pleasure. Thank you.
We've got all your markets action ahead. Stay tuned. You're watching the Morning Brief. We're wrapping up Q1 earnings season in the next couple of weeks, so we still got some time here. But according to FactSet, more than 90% of S&P 500 companies have reported quarterly results, 78% posting profit beats here. And Goldman Sachs equity strategist David Costin says he's noticed 3 themes that have dominated earnings calls: AI, the U.S. consumer, and cost controls. Now, starting with AI, Costin's team says 41% of S&P 500 companies discussed AI, artificial intelligence, on calls versus 23% a year earlier. And of course, we know consumers and cost controls. Cost controls, interesting because that can go one way or the other. That can mean that you hear from companies saying that they're going to be pulling back on spending in certain areas of the business, maybe operationally, in order to reinvest in other large areas where they see demand being a boon to their business. And I think about Meta Platforms and how that company, sure, they had a solid quarter, but at the same time, they announced a major kind of wave of investing that they're anticipating coming forward from here on their generative AI ambitions as well here.
Yeah, and exactly what Goldman is saying within this note. They're saying that firms this quarter have emphasized the actions that they've taken to manage those expenses and to keep costs under control. And that is a theme that they expect to continue here for as long as this uncertainty remains over the timing and the magnitude of policy easing. So that is a theme that maybe they are expecting here to hold in the current quarter. I also want to go back to what you led with there, and that was what we're hearing about AI. And what stuck out to me was where AI is being mentioned in terms of that sector breakdown. And energy seeing the largest increase in the proportion of companies that are discussing AI. And to put that even more specific here for the audience, nearly 70% of the S&P 500 energy companies have mentioned AI on their earnings calls, and that's versus just 19% last quarter. So as the discussion starts to shift to the energy transition, to the role that the energy companies are going to play and to support those AI demands, we are starting to see that become more of a focus here for investors. And as a result, we are also seeing it become more of a focus for executives as they are trying to win over the fact with analysts, with investors, that they are at the forefront of this transition and that they are well positioned to capitalize on this going forward.
We didn't even talk about the consumer. Relatively consistent is what the CFO of Walmart says.
Sums it all up.
There we go.
All right, Madison Mills joining me for the next hour on Catalyst. We will be right back. a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and welcome to Catalyst.
It's Thursday, May 16th. Let's dive into the catalyst moving markets today. Cooling inflation, that is the catalyst that drove record highs in the S&P 500 and the Nasdaq. Markets losing a bit of steam, though, after hitting those all-time highs, as investors still wait on more clues on the Federal Reserve's path forward.
Those clues to come with a slew of Fed speak on tap today. New York Fed President John Williams already speaking this morning, saying that he's not ready to seek rate cuts.
And Walmart holding on to gains as shoppers are going for value. These results kick off a slew of retail earnings that will indicate how consumers are responding to inflation. Well, Walmart brings us to the big story that we're watching today, which is the state of the consumer. From retail sales to company earnings, we're seeing mixed reactions to high prices coming from inflation. But those Walmart sales, they're up, and the company says consumers are trading in. Notice they're not calling it trade down, as consumers across income groups contributed to the retailer's higher sales here. But that is not the universal story. Companies like Home Depot, Starbucks, McDonald's, Etsy, and eBay all showing signs of consumer weakness. Yahoo Finance spoke to Oliver Chen, TD Cowen's senior research analyst, about the state of the consumer. Here's what he had to say.
We see the bifurcated consumer, a pressured consumer at the low and middle end, and a consumer who's balancing more expensive needs. Bottom line, a consumer is under pressure, so there continues to be cautious optimism.
Cautious optimism, Shauna, but with Walmart in particular, it raises a question. Is what's good for Walmart actually good for the economy? Because it can be a sign of consumers trading down. Now, having said that, a really interesting stat from Walmart, they say that overall inflation levels for the business were up about 40 basis points for the quarter. That is half the rate of increase we saw last year, but that's obviously still an increase. Even slowing inflation, it's still inflation. And we have seen signs that consumers are starting to get tired of inflation across the board with other retailers.
We are certainly, and we're seeing shoppers going for value. Walmart clearly benefiting from that. You can see it in these results here. You can see it even if you just take a look at the share price right now. We're at record highs. We're seeing this move to the upside today. We also spoke with the CFO of Walmart, John David Rainey, last hour, asking him about his sense of the consumer, what he is seeing at Walmart, even here in the current quarter. And he highlighted the fact that wallets are still stretched. They're looking for value. They're using discretion when they're buying those higher income items. And he also said that he remains confident that Walmart will be able to continue to attract that higher income consumer once inflation ebbs. And I think that's one of the big questions out there for analysts right now, whether or not we are going to see that higher income consumer continue to shop at Walmart once inflation hopefully isn't as big of an issue for millions of Americans as it is today. But he did really highlight the fact that consumers do remain under a bit of pressure. Walmart clearly benefiting from that. And also I want to highlight one of the other points that stuck out to me within this report were the inventory levels that did improve here for the most recent quarter. They are shaping up nicely here for Walmart, and that's also fueling some of that optimism for the stock as well.
Yeah, it's a great point, too, that he spoke to you guys about, that it's not trade down that they're seeing. It really is a higher consumer liking Walmart stuff.
All right, well, let's continue to talk about these retail earnings that are picking up. Stocks potentially waiting for this next big catalyst. We are right at record highs, though. You got the S&P above 5,300, Dow 40,000 watch continues. We want to bring in Banu Bueja. He is a UBS Investment Bank Chief Strategist. Banu, it's great to see you here. So I'm curious, how are you looking at these current valuation levels and what it means for potential upside from here?
Look, I think the potential upside in equities is reasonably limited because valuations are quite high, which is remarkable given where interest rates are. We just have to bear in mind that interest rates are not the entire discount rate. The discount rate is the risk-free rate plus risk premium. And if the risk-free rate is high, at this minute, actually risk premia are extremely tight. You can look at credit spreads, and credit spreads are actually approaching the tightest. And that's one of the reasons why valuations are as high as they are. We find it quite difficult to see further upside in valuations. What is true is that companies still have very high margins. You were speaking about consumer companies. Although discretionary companies are not giving great results, as you guys were discussing on the program, some of the staples companies are giving you some really good results. And even within Walmart, there has been sort of greater supply or greater revenues coming from staples. So the earnings picture still is reasonably robust, and we think it will remain so for the coming quarter or so. But beyond that, we think the U.S. economy will slow down. I think already when you look at where the retail sales numbers are, when you look at the control group for retail sales, compared to where the numbers were in the second half of last year, so Q3 and Q4 of last year, you're beginning to see sort of a palpable slowdown. And we think that this will begin to sort of permeate into company earnings also. And we think that by Q3, these numbers would be looking a little bit weaker. And so there is upside. We're looking for the market to go towards 5,400, but not much more beyond that. And if I was to look at bonds relative to equities over the next 12 months, I would firmly favor bonds.
Banu, how much weakness? Can you drill down a little bit more just in terms of what we should be expecting with that pullback?
So if you're thinking about where the S&P goes to, so from 5,400, you could actually see the market going sub 5,000 before it rises again, because we do need, I think, a reality check in terms of earnings expectations for next year and year after next. The market effectively is pricing in Goldilocks. The market is effectively pricing in very strong earnings growth, very strong revenue growth with very low inflation. So inflation expectations have gone up when you look at things like University of Michigan survey. But when you look at the actual inflation break-evens in the fixed income market, those numbers are still quite low. So the market's pricing in very strong growth with very low inflation. And that's a combination. We've had that through 2023. I don't think it's likely to persist. And I feel quite strongly that while inflation will come lower, it's growth that is likely to surprise to the downside.
Well, Banu, let's look global here for a second. Looking across equities in China and Europe and the U.S., particularly with the Nasdaq, there is a winner here, right? And it's driven by tech. I know you're not long the Mag 7 right now. Do you think it's time to short U.S. equities and go long on the FTSE?
We do prefer global equities relative to U.S. equities. But again, let me say this as clearly as I possibly can. That's within the context of being not very ambitious with equity returns over the next 12 months. We think sort of mediocre returns over the next 12 months. And in most places, China is an exception, Japan is an exception, but in most places we prefer bonds to equities. It's only in China and Japan where we actually prefer equities to bonds, where valuations are at a much lower level. And we spoke about Magnificent Seven in tech. We've liked tech for a long time. We're not chasing Magnificent Seven at these levels. We do think that while tech does make sense globally, there are many other markets where we'd be long tech, including in China, where we've been long internet for some time and we would be long internet. That's a tactical trade. That's not a trade I want to hold on to for the next 5 years, but I think it does make a lot of sense over the next 3 to 6 months. Similarly in Japan, so Korea, Taiwan, these are places. So APAC is where we are buying tech. US is where we had bought tech and are not chasing it anymore.
All right, well, let's talk bonds because you mentioned it. There's this camp of people buying European bonds to diversify against the U.S. They're closer to easing, but there's a yield disadvantage there. So what is better, diversification or higher yield?
High yield, because those yields are likely to come lower. I think the ECB is reasonably well priced by the market. I don't actually disagree with market pricing for the ECB for 2024 and 2025. I disagree strongly with the Fed's pricing for 2024 and 2025, more so 25 than 24. I think 2 cuts is about right, but just having 2 cuts for 2025 is much too low. I think the market, it goes back to our earlier discussion, I think the market's extrapolating the strength of US growth into 2025 as well, whereas there's a lot of one-offs that help growth, including fiscal, including very strong immigration, which we don't think will likely to be in place. They're not likely to be in place over the next 12, 24, 36 months. So we are looking for a step down in growth and therefore also a step down in inflation. And that means we think the Fed is likely to cut more than what is being priced in 2025, much more than what is priced in. We find greater value in US bonds than European bonds, much as I completely concede that ECB is likely to go first, but that's fully priced. What's not priced in the market is that the Fed is going to cut more, we think, in 2025 than the consensus says.
Well, in rate cutting, it's not necessarily good for markets. What is your thinking on that and the impact it could do to U.S. equities?
Yeah, this is where I think many folks get it wrong because we've lived in this world of quantitative easing over the last 10 to 15 years where sort of your Pavlovian response is if the Fed's cutting, you buy, because usually Fed's dovishness has come with a huge amount of money supply also coming through in the form of quantitative easing. Whereas if you look at the larger swathe of history, that relationship doesn't hold. Over the larger sort of, if you increase your sample size, you will find that usually when the Fed is cutting, revenues are declining. So your earnings estimates are coming lower, and more importantly, your risk premia are rising. So to put this in concrete terms, even if your risk-free rate is coming down, let's say by 100 basis points, let's say US yields go from 4.5 to 3.5, I'm talking about somewhere between sort of the 2-year and the 10-year, let's call it the 5-year note, is going down by 100 basis points. But at the same time, high-yield credit spreads are widening by 200 basis points, which does not stretch my imagination at all. Then, contrary to popular belief, you will actually see the discount rate go up rather than down, the cost of equity go up rather than down. What most people respond to is the quantitative easing world, when the Fed used to engage in quantitative easing, and along with the risk-free rate coming down, risk premia also used to come down by design, not by accident. That's the entire point of QE, that you want to kill risk-free rate and you want to kill risk premia. That's why you do QE. But in a normal world, in a non-QE world, what you're likely to see is that the risk-free rate comes down, but risk premium widen out. So the denominator of your NPV, your discount rate, is actually going up at the same time as the numerator of your NPV, your cash flows, are being revised a little bit lower. So that's not always positive for equities. And I think the market, most of our investors actually misunderstand that.
Banu, thank you so much. Really great insights. Appreciate you joining. That was Banu Buweja from UBS. He's the investment bank's chief strategist. Turning now to gas prices, which could go up by more than 10 cents as we head into the summer, the busy travel season there. That is according to the U.S. Energy Information Administration. Here to break down the driving forces behind possible rising costs is our very own Inez Frey. Inez.
Yeah, Madison, and the EIA saying that this summer you could see prices at the pump up by about 10 cents per gallon. And that is if refineries reduce their output, if their capacity for output goes down, also if their costs for these refineries go up. Remember that a lot of these refineries are older, so the cost to maintain them is higher. Now, we are seeing that at the pump, the average national price is right now at $3.60. Prices for gasoline pretty much peaked around in April, and that was when you saw crude oil go higher. That was because you saw some refinery interruptions. $3.60 a gallon. A week ago, it was at $3.64, and a month ago, it was at $3.64. So you can see that they have come down off of their peak. Of course, during the summer driving season, you are seeing prices that are higher also because of the more expensive blend that is used during the summer. So the base case scenario now for the EIA is for prices to be at around $3.70 per gallon. As far as oil is concerned, oil has come off of its April peak. It's down about 8% from that April peak, and we can show you the oil charts here. Brent crude is at $83 per barrel, WTI at around $80 per barrel, and a lot of analysts are expecting OPEC Plus to extend its output cuts beyond June. They don't expect Brent prices to go up above $90 a barrel. OPEC wouldn't want that. There would be a recession worldwide. If that happens, then you would see demand coming down. So the range has been pretty tight as far as what analysts are expecting for oil prices for the second half of this year, guys.
All right, Inez, thanks so much for breaking that down for us. Coming up, we're going to take a look at Under Armour. That stock on the move to the upside now. Now shares are up just about 1%. The move higher coming despite a disappointing report here for the company. We're going to break it down and why we're seeing this move to the upside when we come back.
Let's do a check of the market sponsored by Tasty Trade. Looking at green across your screen, the Dow still testing that 40,000 level, the S&P 500 up about 0.1%. Same with the Nasdaq. Taking a look at volume, though, this is kind of a meh morning heading into the trade. We're seeing that volume on the S&P 500 is about 10% below the 20-day moving average, as investors still awaiting the next catalyst, which perhaps could be that Fed speak coming out throughout the day here.
All right, well, Under Armour shares are actually moving to the upside here. We're looking at gains of just about 1%. Now, this move to the upside coming despite the fact that the company reported a weaker than expected fiscal 2025 outlook. For more on where the retailer will likely go from here and what exactly this report means for the future of the business, we want to bring in Simeon Siegel, BMO Capital Markets Managing Director and Senior Analyst. Simeon, it's great to talk to you. So explain to us, because I think a lot of people initially looked at the report and would expect to see shares under pressure, yet we are looking at gains here this morning. Why?
Hey, great to see you. So, yeah, listen, I think, Shauna, you and I have talked about this before. Under Armour was a very large business that was overselling and under-earning. They were selling a lot of goods. They just weren't selling them at a great profit. And so today, you got them coming out. I mean, you and I have used this term, sell less, charge more, for years. And in their press release, they said they realized they need to start brand elevating and focus on achieving more by doing less. And so I think the initial reaction, we all chase revenues, we all want to look at revenues, and so the revenue guide was very disappointing. But if you take a step back and look at this, you can realize that Under Armour is an undervalued, under-earning brand. And if the company is finally willing to acknowledge that, if they're looking to say, we really need to do better rather than do bigger, then the stock is undervalued, in my opinion.
Well, Simeon, I'm curious what your thinking is that's different than the rest of the folks on the street here, particularly because we're seeing that volume on this name is nearing its lows of the day, even pre this earnings print. So that indicates to me that there might not be a ton of conviction to the upside. Where is your conviction coming from?
Sure, absolutely. And listen, to be fair, this is not a new view, which means as the stock's been coming down, my view has been wrong according to the market. So for the market. But I think that's the beauty of this. I think the reality is we're supposed to look for market dislocation, right? If the view continued, if we just chase the market, then you're not actually taking a view. And so I think what's important here is this notion that it's very hard to internalize that revenues are not necessarily the be all end all. We're trained to think grow or die. We're trained to think everything is predicated on top line. And so what that means is when a brand that has been a growth brand starts hitting saturation points, you start watching the quality of sale erode long before the actual sale. It's easy to force a revenue. It's just hurting your brand. And so when you're thinking about what do you want to pay for brand equity, what do you want to buy from a stock perspective, I think it's very important to remember that revenues aren't always good. And so I think we are trained in the market and the group. And to your point, as we think about the technicals and the dynamics there, revenues drive the conversation. But I would argue revenues are actually lagging. They're not the leading indicator. And so I think this will take time. We put out a report earlier this morning flagging that the shares are down, but gross margin is a huge pivot. And it's a huge positive. I didn't necessarily think the stock was going to be up today, but I thought this was a huge tone shift that meant the stock will be up. And so whether or not the day trading and where we end up, I don't know. But I think what we do know is if they're committed to improving this brand, this is a brand that does $6 billion in revenue and has a market cap that's less than half of that, or is around half of that. There's a mismatch.
So, I mean, I think the narrative, or one of the narratives that we have talked about with other analysts most recently when it comes to Under Armour, is that maybe they have a product issue, just in terms of their products not necessarily resonating to the extent that they had years ago with consumers. Are those fears then, do you think, just overblown?
So here's my problem with that. And this is a conversation you and I have had about Under Armour, about Victoria's Secret, about even Peloton, right? About different brands where the story, whether it's the media, whether it's consumers, whether it's us, it doesn't matter. We say a brand is dead. We forget that there's $6 billion of revenues arguing otherwise. And so I think you and I actually just talked about this with Nike. We need to look at the revenue to determine if people are buying the product. We need to look at the gross margin to determine how much they value it. So a brand is as big as its revenues, it's as valuable as its gross margin. People are willing to buy this product. And so everyone condemning the product, everyone condemning the brand, saying it's missed the plot and it's dead, it's just not true. How do I know? Because of all those billions of dollars of consumer spending that's telling me otherwise. But that doesn't mean it's healthy. And so if you can take those revenues and actually do more with less, that's that sell less, charge more, then all of a sudden there's actually more value. You can make more money. And it's hard to come to that. And a lot of times the market doesn't give you that benefit while it's happening. It's a painful process to report down revenues. but you emerge stronger on the other side, and that's something that people pay for.
Simeon, you also cover Peloton, and that company, as you know, reportedly hired JP Morgan to raise $850 million through new loan sale. That's aimed at helping the company tackle their debt. At this point, do you think Peloton can tackle their debt on their own?
So it's an interesting segue because it's an interesting dynamic where Peloton still does. And historically, I've had a fairly concerned view when talking to you about this company. I think right now we do have to acknowledge that there's 3 million subscribers, which means almost 6 million people, but there's 3 million subscribers paying $44 a month with a very healthy profit flow through. And so Peloton, to me, is running two separate businesses. They're running their existing business, which is actually an incredibly profitable cash flowing business that could service debt. And then there's the chase for the new customers, which seems to take all that money and plow it and essentially flush it down the toilet. And so I think what my suggestion would be, and has been, is you bear hug your brand loyalists, you focus on the fact that there is a very healthy business with incredible cash flow that could deal with the $1.7 billion of debt, and then figure out whether to pay it down or to refinance it, to your question. But to do that, you have to acknowledge you're not an uber growth business. And again, that's why it's an interesting segue from Under Armour. I think some of these companies take a breath and they say, okay, we need to restructure. But in the same sentence, they say, but we're still going to grow. That's dangerous and it rarely works. There's a time when companies are supposed to grow, and there's a time when they're supposed to focus on value and improving their brand and restructuring. I think Peloton is very much in that latter phase, and that's not a problem given where the stock is today. I think you could make that conversation, that argument, but they need to want to do it.
Simeon, how long do you think it's going to take for this turnaround story for Peloton to take place?
So it's a great question because I'm not leading the company. So I think that it depends. I think it's rare that you have a gift that the answer lies in management's hands. I think certain things, Under Armour, we're talking about, there is some externality, there's the macro. When the argument is to shrink your business, it's actually under your control, but you have to want to do it. And so I believe that if Peloton wanted to just focus on that core existing user base, I don't even have to grow into a cash flowing business. I have it. Like, again, they convince people in their homes to get on a piece of equipment and pay $44 a month. That's a beautiful margin. All they need to do is focus on that and stop trying to believe that there's massive growth. And I think that turnaround happens really quickly. The problem is, you and I have been talking about this for years, where it's not what they wanted to do. And we've watched the stock and the cash bleed because of it. I think what they need to protect, they need to make sure they don't bleed their existing users. If they churn their existing users, if they don't bear hug those loyalists, then everything I just said is out the window. But if they decide we're going to use our dollars to focus on making sure people don't leave the system, because those people are incredibly profitable, instead of using our dollars to try and fight others and subsidize new members, I think the turn happens quickly. If they don't, I don't think it happens at all. And I think that's kind of what we're grappling with and figuring out what is the new management going to do when they are brought in.
All right, Simeon, we got to leave it there, but thank you so much for joining us. Really appreciate it. That was Simeon Siegel. He is BMO Capital Markets Managing Director and Senior Analyst. Shares of Baidu falling this morning, down a little over 1% right now. This comes after the company reported revenue growing at the slowest pace in more than a year. They did beat forecast estimates driven by recovery in ad sales, cloud sales as well. But it's interesting to see Baidu moving to the downside after their positive move to the upside earlier today, Shauna. Another stock that we're following is the Chinese retailer JD.com, which beat their estimates after price cuts and coupons boosted their sales. And I think it's possible that JD's move to the upside is weighing a little bit on names like Baidu and also Tencent as we head into the next session of the day here.
Yeah, when it comes to JD.com, just to start there, because I think this is really a good bellwether of consumer spending right now, or the health of the consumer within China. And we talk so much about the recovery that is taking place there and the sluggish recovery that is taking place. So when you take a look at least JD.com's results, you had a 7% rise in revenue. That beat the street's expectations. They were offering more deals. They did slash prices. They're doing everything they can to fend off that increased competition from the other larger players within that space. So right now, at least, that is helping to drive some of the results that we are seeing for JD.com in its most recent quarter. Then you compare that to what we saw at Baidu. And yes, there is reason to be a bit optimistic when it comes to that profit beat, much higher than what the street was anticipating. But I think the questions surrounding AI, surrounding autonomous driving technology, surrounding the investment there, that might be what is holding back Baidu just a little bit here. When you take a look at Baidu's cores here, adjusted operating margin, that was flat, holding flat at 23%. So that is being called out a little bit here in this instant analyst reaction that we are getting to these results. But again, two trending tickers here at Yahoo Finance. That's giving us a better idea of the state of the economy over in China right now.
Yep.
All right, let's also take a look at John Deere. Speaking of the state of the economy, a look here at the U.S., the company lowering its full-year profit forecast. Declining food crop prices has seen farmers buying less tractors and other farming equipment. We're looking at losses here of just nearly 3%. When you take a look at some of the other details within this report, and again, we're closely watching this because of what it signals about the larger U.S. economy right now, but cutting its annual profit outlook with farmer demand slowing here. The U.S. farm income set to slump this year. So again, a bit of a worrisome sign here for the company. And as a result, we're seeing shares move to the downside here, Maddie.
Well, it's interesting. As you mentioned, this is a bellwether as well for the overall agricultural footprint here. One analyst from Bloomberg Intelligence saying that the reduced outlook, despite better than expected second quarter earnings, it was largely driven by a decline in the small agriculture and turf business and weaker production and precision profitability. That could also be an indication, given that it was almost 8% below consensus, of a deterioration in the global agricultural space amid elevated inventories as well. We've been talking about the companies that have been able to handle their inventories versus those that have struggled. This is a concern for a company like John Deere, particularly given the volatility that we've seen with their inventories as we've come out of the pandemic here. Well, even with summer around the corner, luxury parka maker Canada Goose is up this morning after beating market expectations for quarterly revenue and profit. The Ontario-based company continues to see growth in the Asia-Pacific market, with revenue jumping almost 30% in their fourth quarter. Now, this is after an over 62% rise last quarter. With a name like Canada Goose, I think about what our last guest, Simeon Siegel, was saying, which is that you can actually benefit from having a more expensive product that you produce less of, and particularly if they're able to get revenue out of a place like China that we know is struggling with consumer sentiment and spending, that is a really big deal for them. They are just seen as just meeting their yearly sales target, so not a huge beat there, but obviously that's not the metric that the stock is moving on.
Yeah, exactly. It is important to call out maybe some of the weakness that they are seeing, though, when it comes to the wholesale revenues. That declined 9%. But it was a smaller decline than what we saw the previous quarter. It actually declined 28% the previous quarter. So again, some improvement there. But when you talk about the fact that there is still demand out there for some of those higher price goods, especially from the higher income consumer, you don't have to look any further than Canada's Goose results here just to highlight the fact that there are demand for what their jackets cost. $1,200, $1,300, $1,400 here on average. So again, people are spending, and they're spending big. Those that can still afford to do so within this economic environment. So again, a huge move to the upside that we're seeing for the stock, and the biggest intraday move that we've seen in a couple of years for Canada Goose.
I want to get one on eBay for less.
That would be a good find.
That's my move.
That's my move. It's authentic.
Right, exactly.
That's the risk.
That's the risk. That's always the risk with eBay. Well, finally, checking in on a story that we've been covering all week here. Meme stocks showing some volatility after that rally earlier in the week and a big sell-off today. For more, we're going to bring in our own Jared Blickery. Jared, what's going on with the meme trade?
Well, we're seeing some of the leaders flag a little bit. GameStop and AMC in particular are down today. And you can see this is our meme stock board. I created this several years ago. Haven't really added too many names over the years. And this is just showing you that it's a very mixed situation right now, not seeing any trends. Now, I'm going to sort by performance. And here we can see GameStop, AMC, Tupperware, actually the worst leaders over the last day. That would be today. And also over the last 2 days. Yesterday, we saw GameStop and AMC leading things down. And in fact, we can add cost to this list as well, everything down 25% or more. But when we put the 4-day totals on, instructive to show that GameStop still holding on to gains of 91%, AMC still up 68%, nice gains by Tupperware, Clover up 20%, And also, over the last month, we've seen even more bullish reactions. But I think it's safe to say that the era of meme stocks and what we saw in 2021, largely over. Wall Street was much more prepared this time. And I can take the example of AMC. On a corporate level, they were very much ahead of the game here. They were standing by and they were ready and willing to sell about $164 billion or swap out $164 million in debt for newly issued shares. They had that shelf offering on the table, on the shelf, and they were able to use it. So at least AMC was able to improve their capital position. After that, besides that, I think it's really about some of the individual traders. Haven't heard much from Warren Kitty, but we'll have to see what comes of the rest of the week.
All right, Jared, thank you so much for the Roaring Kitty shout out. We appreciate it. We're going to have all of your markets action ahead right here on Catalyst, so stay tuned for more.
For more than 6 decades, the discount megastore Walmart has redefined retail. In 2023 alone, the company brought in more than $648 billion in revenue. Beyond the Ticker takes a deep dive into the company's biggest moments. Walmart was founded in 1962 by Sam Walton. Its first location was in Rogers, Arkansas. 5 years later, the Walton family owned 24 stores and had racked up $12.7 million in sales. On October 1st, 1970, Walmart went public via an IPO on the New York Stock Exchange. Shares opened at $16.50 per share. The company opened its first Sam's Club in 1983 in Oklahoma in a bid to compete with Costco's wholesale member-only model. In early 1988, founder Sam Walton stepped down as CEO, and David Glass was named his successor. That same year, the first Walmart Supercenter opened in Washington, Missouri, creating what it's currently known for, that mix of general merchandise and grocery. In 1996, Walmart opened its first location in China and surpassed $1 billion in sales for the year. Walmart.com launched in 2000, allowing U.S. customers to shop online as Amazon.com began to take off. To compete with Amazon, among other online retailers, Walmart introduced free 2-day shipping in 2017. During the pandemic, the retailer boomed as consumers sought out the COVID-19 vaccine and meant cheaper groceries as inflation picked up. In late March, Walmart stock reached a record closing high of $61.45 per share, and it only keeps growing from here, with more than 10,500 stores in 19 different countries.
We want to bring a big milestone here for the markets. The Dow briefly crossing 40,000 here for the first time ever. This comes as optimism continues to build on Wall Street. We've seen continued gains here, hopes that the Fed is going to start cutting rates before the end of the year. We've also seen some improvement on inflation, a very, very resilient economy. Also, strong corporate earnings really helping to drive this momentum here to the upside. We are starting to see more of a broadening out in terms of those gains. Defensive sectors have been getting a bid here recently when you take a look at the action in utilities, when you take a look at the action in consumer staples. But again, this move higher for the Dow, briefly crossing 40,000. It's nearly 40% from the lows that we saw back in September of 2022. Since the start of the year, Maddie, we're looking at gains of just about 6%.
Yeah, it's interesting to see those gains continuing today. Taking a look at the volume that was happening in the Dow just as it hit over 40,000 there, it does look like it was an initial pop and then an immediate drop off. So that could be an indication that this is one big move that led to those bigger gains. It looks like it is still teetering. Right now, it's above 40,000. So we'll see if they're able to continue into the gains that we're seeing there into the close. That would be, of course, another record for the Dow. It's looking also like some of the individual names are the ones pushing the index up. We're talking about Walmart here, obviously a big mover on the day, and some of the other names that continue to report amid earnings. They're moving some of the broader indices to the upside. We're also seeing this come after the S&P and the Nasdaq also hit their all-time highs as well. Well, moving on to Netflix, making its first ever sports deal. The streaming giant announced a 3-season deal with the National Football League. That'll include showing 2 Christmas Day games. The company also announced its cheaper ad-supported tier gained 40 million global active users. To discuss, we are going to bring in Paul Durgurabedian. I'm so sorry, I butchered that, Paul. I'm going to have you correct me here.
It's fine. It's all good.
Senior media analyst at Comscore. I really appreciate your patience with me there. But I am really excited to talk with you about this because there's a lot of intrigue about the Christmas Day games. One of the questions I have is whether or not it could be bad for the NFL that this sport is a little bit hard to find, that people may not know where to find it on Christmas Day. Is that a concern?
Well, I think just the fact that we're talking about it now, people will know where to go on Christmas Day, particularly those who are Netflix subscribers. And Christmas Day is typically a huge day for Netflix. People are home, they're with family, they open presents or whatever people are doing on Christmas Day, and then they can sit down and watch Netflix, watch a movie, watch a television show together. So it's very communal in that way on Christmas Day. And have live NFL games on that very important and iconic day is really huge, I think, for the streamer. I mean, they have the boxing match between Mike Tyson and Jake Paul coming up on July 20. They're going to have WWE Raw starting in January of 2025. So really, this foray by Netflix into live sports is, it is a game changer for the company. And if you think about Netflix, how long they've been around and how we used to get the DVDs and then send them back in the mail, if you had said to anyone, 10, 20 years from now, that they would be hosting the NFL on Christmas Day, you would say, really? How does that happen? And think about all the original movies and series they create, reality programming, comedy specials that often go live. So this live component for Netflix in all these different verticals is really, in all these categories, is really, again, a game changer.
Paul, is this the start of a bigger push into live sports?
Absolutely. I mean, it live is very important, as we all know, in terms of sports. Generally, people don't time shift sports. They don't record it and then watch it a couple days later when you can look at the internet and already or on social media and know the outcome. The immediacy of live events is what makes it such a draw for audiences. And so I think to be on Netflix now, we're just before this happened, or maybe just a few years ago, we would have thought you wouldn't think of Netflix or Amazon Prime, Prime Video, who actually has Thursday Night Football there on that streaming platform, that they would be part of the sports world, particularly when over-the-air broadcast, some of those ratings are definitely going down, and many people are going over the top and cutting the cord and watching all kinds of content on streaming. sports is the natural next step in that evolution.
But Paul, how are these streamers, how should they be thinking about these investments into live sports? Because they cost a heck of a lot of money. We've seen the content spend be an issue here for so many of these names. How do they walk that fine line where it makes sense, but it's not going to upset the shareholder here that's going to question maybe the returns that these streamers are going to see on this investment?
Well, that's a great question, because if it doesn't make financial sense, well, then what is the upside for these streamers and for their investors? I think what it's about too is prestige. It's about maintaining subscribers, adding new subscribers through the prestige and high profile nature of something like the NFL and NFL games. So while there might be a little short-term pain, there could be a long-term gain. You know, this is a game of yards, not inches, when it comes to these streamers. And to have NFL football, I think it's a net win all the way around. But you know, time will tell as this space evolves in that streaming world.
So Paul, walk through this situation with me here. Netflix launches the ad tier. Live content does well with ads, so they get into sport. That makes the ad tier subscriptions more profitable. Does that mean that Netflix could end up axing the ad-free option entirely?
Well, it's really interesting. I think for those of us who would prefer not to have the ads, even though some people like them, I think they have to have both. And for those who choose to pay extra to be ad-free, I think that option should always be there. I think it would create a weird perception or a strange perception on the part of the consumer if they go to a platform and it has ads, it's ad supported, in order to lower the cost, the monthly cost or the yearly cost of that subscription. So I think let's keep that option available to those who prefer to pay a little extra not to watch those ads.
Well, quickly here, Paul, it's interesting because Nielsen dropped a media distributor gauge that I've been obsessed with all week. It gives us some intel about, you know, viewership across all platforms, including streaming. Disney's the clear winner, but then you've got YouTube right behind it. I'm curious about where YouTube stands in the fight to become the winner of live sports content. Where do you think they are at?
Well, I think YouTube is always underestimated for some reason. I'm a huge, just full disclosure, I love YouTube. I watch it all the time. I actually pay not to have the ads. And I think that is a major player. There are a lot of people who watch YouTube. I think, look, this is kind of the new frontier for streamers like YouTube and obviously Netflix, Amazon, all the Apple, all the various streaming platforms can benefit from streaming live sports. But it depends on what you're streaming, right? There are top tier sports and there are those that don't get as big a viewership. But YouTube, I think, could be, in other words, it's very fragmented on YouTube. You can get all kinds of content. There could be, I don't know, darts or bowling, some of the cool sports that those of us like, that could be shown on YouTube, I think, in a way that could draw an audience and make it worth their while to put that type of content on the small screen. So we'll see.
All right, Paul Jargarabedian, it's great to speak with you. Thanks so much for making the time to talk with us. Comcourse, a senior media analyst. We appreciate it.
Thank you.
What's the most wonderful time of the year for some hedge funds? 13Fs, they are the quarterly reports that are filed by institutional investment managers with at least $100 million in assets under management, giving the broader market a signal of what institutional money is into. To no surprise, tech is getting lots of love. The value of investments in technology increased the most, while real estate rose by the least for any industry. That's according to the regulatory filings. The other big reveal was Warren Buffett's mystery stock. And to no surprise, it was a bet on insurance. They revealed a stake in Chubb. That had been a mystery here for so many people on the street trying to figure out what exactly that holding was. It wasn't revealed at the annual shareholder meeting that I was at 2 weeks ago. He wasn't asked about it, so here we're getting some insight there. But to focus on this focus that we have seen from these hedge funds when it comes to tech, boosting their exposure to some of these AI darlings, specifically NVIDIA, really shows just where that allocation has been, where it's going, and why we're seeing so many of these companies still mention AI in these earnings calls, because they're trying to get a piece of that excitement that we clearly are seeing on the street.
They absolutely are. And I wanted to, just for fun, take a look at any that were actually selling NVIDIA. And this is not super surprising. Stanley Druckenmiller, his investment firm, cashing out their gains on some Magnificent Seven stocks. They sold 400,000 shares of NVIDIA. They also did this last year, too. So some profit taking there. This isn't like a very bearish signal for NVIDIA. I just think it's interesting. David Tepper's investing firm doing the same. We also have the likes of Michael Burry selling some names, selling out of Amazon and Alphabet, but looking into some of those other big tech plays there. So we saw Amazon actually down on the day yesterday, despite the market rally that we saw. I think that might have been related to some of the moves following that. And then lastly, you've got Bill Ackman, who continues to just be obsessed with Chipotle. So that's always fun to take a look at.
It was also interesting. Did you mention Microsoft there?
No.
Microsoft was cut or reduced by 252 investors, the biggest such number that we have seen.
Wow.
Amazon, on the other side, was increased or initiated by 232 investors, which is the biggest tally there. So we're seeing some divergence within the Mag 7 names, which have been market darlings, where we are still seeing some outperformance there, at least in a handful of them. So again, interesting to keep an eye on there where this large institutional money is making those bets and exactly what that means for the broader market here.
I wonder if they're over OpenAI and some of the drama there. We'll see. Yeah.
Maybe I think it's priced in. Who knows?
Right. Very true. Well, we are going to have all of your markets action ahead right here on Yahoo Finance, so stay tuned for more. You're watching Catalysts. Stocks still climbing higher today, the Dow passing 40,000 for the first time ever. The rally sparked by Wednesday's softer inflation print, spurring optimism around a possible rate cut this year. Investors are watching the slew of Fed speak that we are expecting to get today for any sign that cuts are coming. We already heard from Richmond Fed President Tom Barkin saying that CPI is still not where the Fed is trying to get it down to. But on the flip side, we have the most commentary coming in from from New York Fed President John Williams. He said he does see inflation in the low 2s and possibly as low as 2.5% at the end of this year. That is a lot lower than what the market has been pricing in. So that could be an indication that cuts could be coming this year if that's what he's thinking. But he also runs this model that shows that the Fed has been more restrictive than a lot of people think they are. So he could have potentially biased view there.
Yeah, exactly. And also he couched it a little bit, saying that the Fed still needs a little bit more evidence before they do have the confidence to cut. But you're exactly right. When you talk about his expectations to where inflation is going to be between now and the end of the year, he does see significantly more improvement than what is being priced in right now to the market. So that could suggest maybe some further upside that we could see here. But again, the Dow pushing above 40,000 the first time ever. And I think that just really highlights some of the commentary that we're getting, not only from Fed officials here this morning, but also this optimism that has remained on the street that we are going to get cuts before the end of the year, that corporate earnings have been holding up. That has really been the driver here for the market. So many strategists that we have talked to over the last several weeks have actually been brushing aside some of that rate cut talk, the timing of the rate cut talk, and really focused on that stronger than expected earnings and the prints that we have gotten out so far this earnings season and what exactly that could signal here for future growth, at least in the intermediate term here. So again, that being inflation, the resilient economy, that coupled with very, very strong earnings results, enough to push the Dow here above 40,000. We'll see, though, where we close the day. All right, well, let's do a quick check of the markets. We were talking a heck of a lot about the Dow pushing above 40,000. You've also got the S&P still above 5,300, and you've got the Nasdaq trading up just about 0.2%.
And coming up, wealth dedicated to all of your personal finance needs is here. Brad Smith is going to have you for the next hour, so stay tuned for more.
You hear the music, you know what time it is. Welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks as well that you need to grow your money. On today's show, we get a gauge on America's employment system, and an expert brings you the tips and tricks to beat artificial intelligence in your job search. Plus, oh yeah, we're gonna dive into what Walmart's quarterly results say about the state of the consumer and how they are feeling and spending. Plus, energy prices are up right now. We'll tell you how much inflation is hitting your wallets at the pump ahead of a busy travel season. All that and much more. But let's kick things off with a fresh record. The Dow topping 40,000 for the first ever time in intraday trading here on the day. Take a look at the Dow Jones Industrial Average. There you see on your screen, we're holding above 40,000 right now. And of course, this is amid an earnings season where there's been everything from talk of artificial intelligence into the consumer and much more about the state of the economy. I do just want to take a brief look though at some of those Dow components to really show you what's pushing things higher here in today's trading activity. We're being led on a percentage basis by the aforementioned Walmart that we teased at the top of the show. That's up by about 5.8%. One of the other major catalysts that we're seeing in an attempted rebound here, at least on the day, though down year to date right now by about 30%. Boeing helping some of these gains and getting to that record on the day. That's up by about 3.25%. You've got a sea of green, but still a little bit of red peppered into the equation here as well. But overall here, a new fresh record for the Dow. That means that the NYSE, maybe they're whipping out those 40K hats. We will see. We'll confirm with some of our friends down there as well. But let's turn now in the interim period of time to the U.S. labor market, showing signs of slowing down a little bit. We got a fresh read on the labor market with jobless claims. And here to break down exactly what jobless claims are is our very own Madison Mills. Hey, Maddie.
Hey, Brad, thanks so much. Let's start by just defining what exactly this economic data point is. Initial jobless claims are a measure of the number of Americans applying for unemployment benefits. And this is reported by the Department of Labor every single week. It can give us a good read on the jobs market and the health of corporate America. So behind me, you're looking at the figures for the week ending in May 11th that came in at 222,000. Just slightly above the estimate, which was 220,000. Now, this is down from the prior week of jobless claims, which were revised up to 232,000 claims. And we look at this data to understand the state of the economy because it's what we call a leading indicator. Economic data can often be lagging or backward looking, telling us what happened in the past. But this data point can help us predict upcoming trends in the jobs market. Now, today's data obviously relatively in line with expectations, but you may be thinking, I might feel bad about the economy. How are jobless claims not higher here? Well, there's a bigger question about whether or not the people who are getting laid off are actually filing for unemployment. And if they don't get included in this data. So if you lose your job, make sure you apply for those unemployment benefits right away, not just for the sake of your own personal finances, but also for the sanctity of the economic data that we know and love. And Brad, overall, this data offers more evidence that the labor market is steadily cooling. And that's just one key data point the Fed needs to think about when considering its next policy move.
All right, great setup there. As we're going to discuss the broader employment situation just a little bit further here. Maddie, thanks so much for breaking that down. Well, fewer people filed for unemployment benefits in the week ending May 11th than the week prior. Broadly speaking, layoffs are at historically low levels, and it comes amid growing signs that the labor market is gradually cooling off in the U.S. April added the fewest number of jobs in 6 months. And these days, looking for a job means shooting your resume into the proverbial black hole of the internet. According to our next guest, nearly all Fortune 500 companies use AI screening tools in hiring. So how can you get a leg up on the competition and outsmart these AI tools in your job search? I'm joined now by Hilke Schellman, who is the NYU professor and author of The Algorithm here. Great to have you on the program with us. We're seeing the cover of your book there on screen, and our viewers, of course, perhaps going to be looking that up, as well as all the algorithmic changes that we've had to monitor over the course of this year. All that considered, back on topic of how you can best beat AI in that job search. What are some of the top tips that people can really put to practice?
Yeah, thank you for having me, Brett. And I know, it's really tough finding a job because there are all these job platforms, right? Like I'm sure a lot of folks have sent their resume to LinkedIn, Indeed, and never heard back. And I think we need to throw out the old age advice that a lot of people got is like stand out, have 2 columns and different colors and images. None of that. Today, it's very likely that your resume will be read by a machine, so it has to be machine friendly. 1 column, very short sentences, crisp, clear. Any quantitative data, super helpful. You saved your company $5 million. You have supervised people. What's also helpful is to think through, have a separate skills section, for example, because a lot of companies look at skills first. And I've talked to a lot of recruiters who, when they go on job platforms, they put in like, I don't know, software developer, New York, and Python, and that's a skill. So put all of those skills, including soft skills, in your resume. I've also heard from people who now use ChatGPT, as helpful to them. So they may use ChatGPT to help them generate a cover letter, help them with their resume. I always caution people absolutely proofread your material, right? Because obviously we know that ChatGPT hallucinates, but I think it can be helpful, especially for folks who have a lot of anxiety. And I think it's giving folks some agency back. And also, I would always say, like, it's probably never you. Like, we know from data that it takes hundreds, often thousands of applications to find a job because recruiters and HR managers get thousands of applications often per job. And you can see often the statistics on the job board. So don't be discouraged. It's just a numbers game. I think a couple other things that I have is like if you had a larger than 6-month employment gap, if you were freelancing during that time, maybe make sure it covers that time, because we know that some AI tools throw people out who have a longer than 6-month employment gap. So I think those are kind of like pretty easy things to guard against. I think you can also use some services online like JobScan and others where you upload the job description, you upload your resume, and it will tell you how much overlap probably in an AI tool would infer between the job description and your resume. So aim for like 60 to 80% of overlap. If you have 100%, that might be a problem because the AI tool may assume that you just copied the job description, which you wouldn't want.
Just to jump in really quickly here, because I mean, that was a trove of good tips that you just spelled out for a lot of viewers out there. I wonder, for those who are laying out their resume and trying to make sure that, okay, do I stick to 1 page? Do I stick to 2 pages? Or how do I make sure that I am consolidating the information or making sure that it's concise enough to get my skill level across while at the same time making sure that it's not isolating me or kicking me out or excluding me from any of the artificial intelligence generators out there or kind of initial reviews that you have to pass through as well? What's the best kind of mindset for that?
Yeah, I mean, I think actually sometimes with AI, err on that side to put more skills on there. You don't have to necessarily put more text and description because the AI is probably just looking for specific keywords. So make sure you have a lot of the keywords that are in the job description on your resume. So, I know some people want to be cute and instead of a childcare provider, they might write daycare or something. No, use exactly the words that are in the job description to have that overlap. That might be what the tool is looking for. I also think if you feel like, my AI, sort of computer machine readable resume is kind of weird and technical now, I always suggest people, once you get to that interview stage with a human, bring another resume that you really feel like, oh, that is really showing who I am and I can easily talk about it. Because, we know that like in all likelihood, your resume will be read by a machine first, by an AI tool, and not by a human. So you have to get through that first. And then you can bring, when you meet with a human, bring that resume that you loved and have crafted so many times and show it to them.
Hilke, lastly, while we have you here, college. How much does the university matter on resumes now versus in the past? Some universities are well known for, say, their engineering programs or, say, their entrepreneurial programs, what have you. Where is that kind of ranking in terms of the importance of giving that either a high-profile positioning on your resume or somewhere later on kind of not buried, but still visible within it.
Yeah. So, Brett, what we see now, there's a lot of like theoretical discussion about that. We know that, often bachelor's degrees, like where you went to school, shows more about probably your socioeconomic background than actually your capabilities, right? We often think like, oh, you went to Harvard, you must be really smart. Whereas for state school, we just be like, okay, well, they went to state school. So, but we see this push to skills-based hiring. So actually, some companies now don't want to look at degrees anymore and actually black out sort of where folks went to school. But the unfortunate thing is the data, on the other hand, who gets hired, we've seen some surveys now, and that's a little bit disappointing. So we only see that like 3 or 4% of hiring is up where people don't look at bachelor and master's degree. But it turns out that like humans at the end of the decision making still like to see those bachelor's and master's degrees, even though maybe your job doesn't actually need to have that degree, it just needs specific skills. So we see a lot of AI being trained to just look for those skills, but we see humans still looking at those universities. So you definitely want to put them on there. I mean, you got that degree,
right.
And different tools will look at it differently.
Hilke Schellman, who is the NYU professor and author of The Algorithm. Thanks so much for taking the time here today with some very actionable tips for all of those prospective job seekers out there. Appreciate it.
Yeah, and good luck. And never give up. It's just a numbers game.
Exactly. Thanks so much, Hilke.
Thank you.
Turning now to an update for Americans with student debt. The Department of Education is giving borrowers more time to meet a key deadline regarding student loan forgiveness. 3.6 million borrowers who got federal loans originated through the Federal Family Education Loans Act have until June 30th to request a loan consolidation, which would combine all of someone's loans into one loan in order to apply for an initiative that could wipe out their debt. Now, the previous deadline was April 30th. The U.S. Undersecretary of Education writing in a statement, quote, FFEL borrowers could consolidate and should consolidate as soon as possible in order to receive this benefit that has already provided forgiveness to nearly 1 million borrowers. The department first announced this payment adjustment in April of 2022 to address evidence of mismanagement of the plans, including not giving people the correct information for their forgiveness timeline, resulting in some people repaying their loans for longer than they should have been. Coming up on the other side of this short break, housing starts rebound, what it means for the health of the housing market. That's next. Let's do it. The check of the market, sponsored by Tasty Trade here. Taking a look at the Dow Jones Industrial Average. We are just below that 40,000 marker, which we have hit intraday here, setting a new intraday record for the first time ever, notching the tick by tick above that 40,000 marker. As of right now, we're still holding on to gains of about 0.2%. We'll round that off to the S&P 500. You're seeing that also up by about 0.2% on a percentage basis there. And then the Nasdaq, roughly the same on a percentage basis, 0.2% here in gains. Well, the housing market remains under pressure as high prices and interest rates weigh on builders, buyers, and sellers. Home builder confidence dipped in May as 7% mortgage rates keep many prospective home buyers on the sidelines, according to the National Association of Home Builders. So, how is this reflected in recent data? It's the big question, and here with the latest is our very own Danny Romero. Danny, did May's housing starts data support this sentiment?
Housing starts for both single family and multifamily modestly rebounded, and that is signaling that this recovery could be a little bit slower for new construction. Housing starts climbed 5.7% over the prior month to 1.3 million annualized rate, and this was lower than expectations for a 1.4 million annualized rate. So April's rebound really was driven by multifamily starts, which jumped over 30%, which is a bit lower than pre-pandemic levels. I want to make that clear, but also single family starts remained flat last month. The results do cast some form of doubt for home building. And like you said, this does come after home builders aren't really feeling too confident right now about the housing market, especially that mortgage rates have stayed above 7%, sidelining buyers and, of course, now builders. So home builder sentiment from the National Association of Home Builders did show that builders view conditions as poor. So despite these really bleak expectations from builders, some industry experts say that single family starts could come back, and we could see single family starts reach 1.1 million units by the end of this year. So they're saying that home builders could really capitalize on the low inventory on the resale side. Brad.
Danny, thanks so much. Continuing to track the home market here. We're going to have much more conversation on that in just a little bit here. But in the meantime, Uber is announcing some new features this week, and they might help save you some cash. Uber Shuttle gives riders a cheaper way to get to the airport, work, or live events. Now, it's basically a bus where you can reserve a seat up to a week in advance for a, quote, fraction of the price of an Uber X. And it's not impacted by Uber's infamous surge pricing. Don't like riding a bus? Well, guess what? The platform is also offering shared scheduled rides that let you save an average of 25% compared to Uber X. And good news for students as well out there. Uber is offering an Uber One membership program that includes savings across rides and delivery services. This is going to run you about $4.99 a month and includes discounts like free delivery and 10% off orders. And this is a good one ahead of the summer. Uber Eats teaming up with Costco. Yeah, you heard that right. You're going to be able to order your favorite Kirkland signature items on the Uber Eats platform. This is available now in select locations. Now, the company is also announcing new features for foodies and caregivers as well here. So a lot in the slate of new product announcement and service announcements from Uber. Ticker symbol UBER. Well, coming up, assessing the state of the consumer, shoppers are flocking to Walmart for better deals. But are there other retailers where you can maximize your dollars? Find out next. America's biggest retailer is holding on to its recent momentum. Walmart reported stronger than expected first quarter revenue and same-store sales results, driven by a big jump in e-commerce sales and more visits to its giant supercenters. The company benefiting from gaining market share as consumers seek convenience. And here to tell us more about the consumer, we've got Yahoo Finance's Rochelle Akufo. Rochelle, we got to dive into this. What did you see? I mean, 22%. My goodness, on the e-commerce side there.
I'm telling you that this is why Walmart is keeping its crown as the largest retailer. You're seeing consumers continuing to bargain hunt, and it's happening across all income levels. Now, comparable sales in the US rose 3.8%. Transactions also grew 3.8% for the quarter, but the average ticket was flat. So you're having more transactions here, but not necessarily at a higher level. So Walmart CFO John D. Rainey joined Yahoo Finance this morning with how he sees the consumer story. Take a listen.
The consumer has been relatively consistent. We are, like everyone else, is looking for if there's something there, something that we should be more aware of, but they've been pretty consistent quarter to quarter here. We see that wallets are still stretched. They're still looking for value. They're still using discretion with buying those higher income items.
And what's interesting, these higher income earners who sought some of these bargains during peak inflation, they've been sticking with Walmart, making up the, quote, the largest cohort behind share gains in nearly every category. Now, for shoppers who prefer to buy in bulk, including small businesses, not just people who show up to buy a canoe from, say, Sam's Club, now that's a Walmart subsidiary of Walmart. That was also a standout. We saw comparable sales 4.4% higher, which also added grocery market share and of course boosted Walmart's overall comp sales data. Now, investors did have an inkling, especially if you look at some of the data compiled from Seeking Alpha, which showed that Walmart was the least shorted consumer staple stock in the S&P 500 for April. So clearly there are a lot of people seeing this continuing flocking of bargain hunters. But when you think of Walmart shoppers, you think, perhaps it's just people looking for a bargain, but it's across all income levels here, Brad.
I mean, absolutely. And they've got some great golf shorts for $13 as well. So you can't argue with that. What can we take away from this report about where consumers are headed next and the sentiment?
Well, obviously, when you look at Walmart, Walmart is considered a bellwether because it covers a bit of everything. It's logistics, it's shopping. But it really comes down to meeting consumers where they are right now, financially and physically. And so Placer.ai uses data on things like foot traffic, transactions, digital shopping behavior, which of course you mentioned e-commerce, as well as the demographics of consumers to help retailers figure out the trends ahead, where to find these consumers and how they're shopping. And it's interesting because Walmart dominating there too. So Placer.ai is finding that the Walmart banner receives over 60% of all visits to Target, Walmart, Costco, Sam's Club, and BJ's, especially in the South, where Walmart superstores' relative visit share tops 70%. Now, you will see there are plenty of other states and areas where Walmart isn't dominating as heavily. So some potential for more expansion for Walmart or potentially more competition as rivals see some openings there. Another interesting angle that we're seeing from Walmart and some of these specific brands that you do have to dig into because there is a lot of nuance here. Stronger sales growth in international markets than in North America, where you are still seeing that inflation story play out there. So certainly some opportunities to be had. Might have to look overseas as well for some of those deals. Brad.
Rochelle, thanks so much for breaking down Walmart's earnings here and weaving in that conversation with the CFO, John David Rainey. Appreciate it, Rochelle. Well, Walmart CFO told Yahoo Finance earlier today that the consumer is relatively consistent, but is America's largest retailer the best place to maximize your dollars? Here to weigh in, we've got Jerome Martis, who is the LSEG Director of Consumer Research. Great to have you here in studio with us.
It's great to be here.
I mean, we've been talking about the consumer over different economic cycles for several years now, you and I. And one of the huge things that we're thinking about with Walmart here is how they play within this broader competitive landscape and consumers trying to figure out where they're getting the best bang for their buck. Is it clear where that is right now among the competitive landscape?
I think today's numbers gives us a clear indication that that place is Walmart. That's the place where consumers gravitate for groceries. And while they're there shopping for groceries, they're definitely opening up their wallets for general merchandise. Now, what was great today is that not only is Walmart seeing strength within the store and groceries, but also online. In fact, they smashed their e-commerce expectations of 15% with a robust 22% today. The marketplace sellers have grown by 36%, suggesting that they keep adding more sellers onto their e-commerce platform. Also, their advertisement business grew by 24%, which is actually on par with Amazon's 24% increase in revenue.
You think about how Walmart is describing the consumer right now. The CFO of Walmart, John David Rainey, telling us in an interview earlier today that wallets are stretched, that the consumer is consistent, or relatively consistent here, and they talked about how this factors into their guidance going forward. Without kind of looking specifically at the financials here, how would you describe the state of the consumer right now?
So it's interesting because we've actually seen the consumer started to open up their wallets for general merchandise. And that was very evident even in yesterday's April U.S. retail sales numbers. We saw that clothing was up in the month of April, despite April being a flat month. And on top of that, in a collaboration with Centric Market Intelligence, IXIC discovered that the amount of merchandise and the average discount in 2024 is significantly lower than what we've seen over the last 3 years. So this is telling us that despite the fact that there are lower markdowns, consumers are still they're starting to open up their wallets for general merchandise. And that was very evident in Walmart's numbers today too. They said that everybody goes to Walmart for the lower everyday prices and the rollbacks. Right. But despite having lower rollbacks, we saw that same-store sales were still very strong. So we're seeing that consumers are willing and able to extend themselves. And why is this? Is because their security in their job right now. The consumer confidence reports are telling us, that the consumers feel very secure in their job, and that's why they're feeling better about extending themselves a little bit more.
It feels like every week we hear a new iteration of what a rewards platform looks like for all of these retailers, whether it's Walmart, whether it's Target, whether it's Amazon as well. All these things considered, where is the best kind of rewards relationship that consumers are experiencing with these retailers?
I think one thing that was very evident in e-commerce and in Walmart's e-commerce numbers is the fact that more consumers are learning to trust its omni-channel platform, right? Think about all the people, we just talked about the pandemic, right? About how you had to stay at home and order online or wait outside,
I was waiting outside, my goodness, for groceries.
Yeah, so think about all the amount of people that Walmart gained during the pandemic on their e-commerce. And on top of that astronomical gain, they now posted another 22% growth. That's huge. Right. One advantage that Walmart has over Amazon or the other competitors is its location, right? Walmart is located, its proximity is to 90% of the US population. It has a store within 10 miles of 90% of the US population. So because of this, we saw today for the first time that Walmart saw stronger deliveries than store fulfillment. So they're using their stores very wisely, and this is actually their upper hand that they have on Amazon, that they're using the stores, their proximity to the consumer, and the fact that now consumers have learned to trust them.
Is healthcare or the pharmacy benefits part of each of these programs or each of these storefronts? Is that the next major competitive element for all of these businesses?
Absolutely. We're seeing that that is a big driver. We've seen that for Walmart, especially this year. Others are also trying to compete. Costco has always been a favorite, even when it comes with prescriptions. But yes, when it comes to matters of health, that always gives a discounter an upper hand.
All right, customer lifetime value. Those customers got to be alive for that to prove true for the businesses, and some of those businesses trying to make sure that they can offer that connection point. Jerome, great to see you.
Thank you for having me.
For joining us in studio. Jerome Martis, who is the LSEG Director of Consumer Research. And everyone on the other side, actually, let's do this right now. It's a great time for it. Yesterday's Consumer Price Index showed that the cost of shelter, which includes rent, grew by 0.4%, putting it up over 5% from this time last year. So it's now a good time to invest in real estate. For more, let's bring in Lauren Hochfelder, who is the Morgan Stanley Real Estate Investing co-CEO. Great to have you here with us, Lauren. First and foremost, a lot of people just trying to figure out how much they should be allocating, if they are allocating a real estate investment here. What's a good way to get an entry point in?
So, hi, Brad. Thanks for having me on, and always love to talk to you about real estate. So, look, we think this is a really, really interesting time to be investing in real estate. We're 2 years into a real estate correction, and you're seeing broad repricing across the board. There are certainly some assets that are distressed for a reason. We tend to stay away from those. But across the board, there are a lot of asset classes that are really interesting, performing quite well in terms of income growth, et cetera. And yet they're pricing off materially 20, 30%. So we think it's a really interesting time to get in.
Let's kind of drill down on it, because real estate, very broad. Are we talking single family, multifamily, rental units? What is it that is seeing the most kind of demand, or the most opportunity, at least, as an investment mechanism?
Yeah, so we like to invest behind broad mega trends that drive demand through cycles. And so some of the mega trends we're focused on today are continued growth in e-commerce. I heard your conversation about Walmart e-commerce sales, and that absolutely, as a trend, continues, and that drives a lot of demand for those warehouses that get those goods to our front doors every day. So that's one. The second is a complete realignment in the global supply chain. So simply put, the supply chain of the last 20 years will not be the supply chain of the next 20. We're doing a U-turn on globalization, all these event-driven supply shocks. And again, as companies are forced to rebuild their infrastructure in response to a realigning supply chain, that too drives demand for warehouses. The third is, look, we have aging demographics. As a population, we are aging, and that is changing our housing preferences and needs. So there is a lot going on. And in real estate, you have to distinguish between changes in interest rates and changes in how people use space.
I want to linger on that for a hot second here, and the changes in interest rates. How is that weighing into the decision as people weigh real estate as an investment mechanism and asset type?
Well, look, real estate is a levered asset class, and of course it is heavily impacted by interest rates. I'd say that we like to invest in a way that we can perform through any interest rate cycle. Today you're seeing a lot of asset owners who acquired assets and financed them heavily in a very different interest rate environment, and they are getting squeezed today. They have maturities coming up, and they cannot refinance that debt at the current levels, and that's creating pressure in the system. We focus on having durable capital stacks that enable you to get through any interest rate environment. And frankly, we focus on investing in real estate where you can really push income growth, where you can grow your top line in excess of any rate expansion.
When we think about real estate investing, it comes back to one word repeated 3 times continuously: location, location, location. And for any of the types of real estate investments, whether it is looking at warehouses, whether it's looking at even the build out of data centers or even multifamily homes, all of these things considered, it still comes down to where those are placed. Is there a hot spot where you're seeing investors kind of flock towards in their calculus of the locations that are best serving for this as an investment strategy?
Absolutely. Look, first, I'd say on a global basis, I do think the U.S. is really the most interesting place to invest today. But let me say, you're absolutely right. It was ingrained in my brain, location, location, location. But I'd say today it's actually, of course, location is paramount, but I would say it's dislocation, dislocation, dislocation. You have to look at how things are changing, whether that's where people are moving. So, I would have said 20 years ago, you want to own assets in New York City. And certainly there are some you still want to own here, but people have migrated, right? People test drove a lot of different things in COVID. They test drove different working conditions. They decided they liked working from home. They test drove different markets, right? So Miami, Dallas, some of these markets to which people moved really changed the location of where you want to own real estate.
Lauren Hochfelder, who is the Morgan Stanley Real Estate Investing Co-CEO. Thanks so much for taking the time here with us, Lauren.
Thank you.
Absolutely. Guys, coming up, will you be able to retire by your early 60s? Some say it's unlikely. I'm optimistic for you out there. I'm hoping to do the same, but we're going to find out why those naysayers are out there next. According to new data from the Federal Reserve Bank of New York, there's been a big shift in how Americans envision their post-working years. And here with the details, we've got Yahoo Finance's Carrie Hannon. Hey, Carrie, what do we know here?
Hey, Brad. Yeah, this is significant. And in the last 5 years, the number of Americans who say that they will continue working after age 62 has dropped from 55% to 46%. So most Americans are saying, I'm out of here at 62 for full-time work. And, I think there are a couple of things behind that. If you kind of dig below it, although the researchers didn't say this specifically, but coming out of the pandemic, I think people had this opportunity to kind of shift to thinking about part-time work because more remote work was available. They started doing the soul searching, I call it the inner MRI, about what's really important to me? What do I want to do with my life? And have opted to say, they don't value work as part of that equation in the same way they once did. And so I think that in addition, the uptick in wealth, right? The markets have been pretty good. Retirement counts for some people are quite robust. So you got this urge to leave, right? But this is why I personally think this is a terrible idea. And a lot of the experts I talk to agree with me, unless you absolutely can't continue working because of a physical issue or you can't get a job because of ageism. And that's very real. But, it's a bad idea because in a sense that, most people are undersaved for retirement, right? Less than half of Americans think they have enough saved for retirement, according to a recent report by Schroders that came out last week. They have medical bills. If you leave at 62, you still have to foot your medical bills until 65 when Medicare kicks in. And even then, Medicare doesn't cover a lot of things. People are mistaken there. So Fidelity has a number that say from a couple that retired at 60, or an individual at 65 retired last year, might have $160,000 in medical expenses between now and the end of their life. Now, this is significant. So I think people don't factor in some of these things like inflation. And then, of course, longevity. We are living longer lives. And if you have to finance 3 decades of living, come on, that just makes me roll my eyes. You have to have been a pretty super saver and able to do that. And finally, look at inflation, right? Costs still, yes, things are toning down a bit, but they're still up and it's expensive. So Brad, that's sort of my take on this whole thing. But again, it is a surprising and significant shift.
We're living longer lives even without Tony Stark's arc reactor implanted in all of us here, Carrie. So what's behind this shift in people expecting to retire earlier?
Yeah, I think it is that idea of expectation. I think this is this desire to take control of our lives and really, embrace things that we weren't able to do during our working lives. And it certainly has been a dream for people for many, many years. I just think the financial realities today make it just a little more tricky for people. And the fact that, it has been difficult, saving, being undersaved is something that is quite, something people have to focus on. So if you want to hit that number and you're young enough, get going. Save hard, save fast, save long, All
right, Carrie, love it. Thanks so much for the constant tips continuously. Carrie Hannon, appreciate it. Well, over the next 20 years, $84 trillion, yes, trillion, will be transferred from baby boomers to younger generations. It's called the Great Wealth Transfer, and a new survey from Citizens shows that Americans are unprepared to take in a large windfall of money. Joining me now to help us understand what a large financial windfall could mean for you, we've got Brendan Coughlin, who is the Citizens Head of Consumer Banking. Just how out of step or underprepared are we for this great wealth transfer?
Hey, Brad, good to see you. It's a really the biggest wealth transfer in the history of the country. And so what we're seeing in this recent survey that we did is that 72% of millennials and Gen Zs lack confidence in their financial plan, and 52% said they've received poor advice in the past. So it really seems to us that generally the recipients and the heirs of this gigantic wealth transfer really needs to do a lot of work between now and when this becomes real for them to feel more confident and prepared.
So what's the number one step? Where can someone who feels like, okay, my playbook is just not up to snuff for when this actually takes place for us, for me, for my family even, what's the number one step that they can begin to implement today?
Well, what's interesting is that more than a third of younger folks have gone to social media to get advice, and that's always a place to start. But at the end of the day, this is big money. And so it really starts with getting trust in your financial advice and actually acknowledging that you need it. And the stat I gave you a second ago with over half of them feel like they've got poor advice in the past is alarming. And so it requires parents and their kids to really start to build this conversation together. Talk to the advisor that your parents have, if they have one. Build that transfer of trust between the advisor. They could still going to be your advisor when your parents ultimately pass on their wealth. So getting prepared so you're not playing reactive defense and start when the event unfortunately happens that you're in this spot. You don't want to be starting flat-footed. That okay, how do I even get introduced to advisors? So really getting in front of that is incredibly important.
Certainly here. And so as we're thinking, out into the future and trying to make sure that there are also, as we're coming out of Financial Literacy Awareness Month as well from April, where there are going to be places, even within the education system, to make sure that this is not something that in financial literacy that people feel like they're behind the eight ball, that they feel like they're actually being proactive with what they know and can actually implement as well. Are we seeing any significant strides there?
Well, I think what's interesting is that if you play on those dynamics of, so many more Americans are going to need more trusted advice, yet largely folks are still telling us they've had some poor advice and they don't feel totally confident with the relationship they have. The entire country is set up from a business standpoint for a really significant overhaul on who the winners and losers are in wealth management and in trusted advice long term. So for brands to lean in and acknowledge this and realize that financial services companies need to do very different things to earn trust and advice with the younger generation, with millennials and Gen Zs. It starts with companies recognizing that and then filling that void. And to your point on financial literacy, being there early on in their life cycle, having the right content and advice, having their people trained to advise them on this is a huge opportunity. We could see a seismic shift on who the winning wealth managers are over the next 2 decades based on who leans in and acknowledges what's really happening and gets in the head of Gen Zs and millennials right now.
Yeah, absolutely. It's interesting as well in how some of the survey respondents were saying that they were going to be putting some of the newfound wealth to use. Everything from buying a new car to just, hey, I just want to take a trip, honestly, to all the way thinking about how those investments could be taking place as well here. And we're taking a look at the full results here. Help us break this down a little bit more and where we're seeing the overwhelming amount of respondents want to put this wealth to use.
Yeah, I think this is it's interesting because you look at some of these stats here: investing, paying off debt, buy a new car, start a new business, pay for education. These are the things you'd hope they would say. So that's a good foundation to start with. That you're not looking at this list and it's, obviously there's travel there too. People want to live their lives, but it's not necessarily a frivolous list of things when they get this windfall that they're prepared to be irresponsible. But when you marry that with the stats that we've been talking about generally not getting a jump start and being prepared, what this is it's just a starting point. It's a list. And so sitting down with a trained professional to really go through your point of view and then calibrating it on the realities of what you're trying to accomplish in life and how to do that. There's all kinds of other complexities, whether it's tax implications that folks need to be considerate of. So anyway, I'm pleased that the list so far has been areas that you'd expect in very responsible ways, but the devil's in the details, and really having a plan that's personalized for you is really where the action is going to be and how you're going to ultimately get to that better place of confidence.
Is it clear how the great wealth transfer can also assist in closing the gender equity and gender wealth gap?
Yeah. Well, I think it gives a new opportunity to reset, right? So when you're in a moment of wealth transfer like this, the heirs are obviously balanced in terms of gender, and so and what we see more and more is that there's an increasing amount of decision making happening in the household with females in terms of being the lead in making financial decisions around money. And so as that has happened generation by generation, I do think as this money transfers that, new sentiment with younger Gen Z and millennials really could actually have a relatively big seed shift here on how wealth gender equity plays out over the next couple decades. So it's a big moment, and it reinforces the need to be intentional and be prepared and really think about this the right way as a family.
Brendan Coughlin, who is the Citizens Head of Consumer Banking. Brendan, great to see you, and thanks so much for taking the time to break down some of the results in the survey.
Thanks for having me, Brad.
Absolutely. Coming up, are you financially ready for summer travel season? I think I am. We've got some tips and tricks to help you pay for your next trip on the other side of this break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Memorial Day weekend is just around the corner, which means the unofficial start to the summer travel, well, kind of official start to the summer travel and vacations, they're about to kick into full gear, folks. According to an April survey from Bankrate, 53% of Americans are planning on taking a summer travel vacation this year, and over a third of them are willing to go into debt to make it happen. So with inflation still prevalent in consumers' minds, what are some ways for you to be financially prepared for traveling? For more, let's bring in Yahoo Finance contributor, Ross Mack. All right, Ross, we got to give some people the tools, the tips, the tricks in order to make sure that hopefully they don't have to go into debt in order to just get some R&R, some time away.
Yeah, well, one, right, I never want people to go into debt. And obviously, full disclosure, I just came back from a vacation with the family. And no matter how prepared you are, there are always going to be unexpected expenses, right? And I think when it's all said and done, the best way to truly prepare for going on vacation, you want to start a year ago, right? Yeah. So you want to start, now you're planning for, 2025 vacation, and everything starts with that sinking fund, AKA the vacation fund. Now you're saying, okay, about how big is my family? Where are we trying to go? Now we're starting to prepare and actually hit that number. You work backwards. Say, maybe it's a family of 5, say you got a $5,000 vacation. Maybe you're putting $100 a week aside in a separate high yield savings account, and now 52 weeks later, guess what? Now you got over $5,000, gained a little interest, and now you're ready to actually travel and not have to go into debt. And another thing, right, one of the things I did literally was I tried to travel hack, right? I literally said, I'm not just gonna settle for the first price I see, right? I'm looking on, Google Flights, I'm looking on Skip Lag, and one of the things I did was say, okay, I'm willing, like I'm coming from Chicago, so I'm willing to fly out of O'Hare and maybe fly back into Midway, right? And so those were some of the things I was willing to do. And I started out purely by doing one-way flights. All right, one way we're locked in. Maybe I'll check back a week later on Tuesday, which are supposed to be the cheapest days. Supposedly, right? Maybe I'll just buy that flight, in a week or so when I look and actually get an alert to see it's actually coming down. And that's some of the things I did. Another thing was, right, where are we staying, right? Obviously, that's a big cost, whether it's, now we're looking at what are the different hotels and we're comparing that to Airbnbs, right? We're trying to get a sense of, is this actually cheaper? You always want to look at what that last line is, that bottom line. Yeah. Cleaning fees with Airbnb and what are the hotel taxes and all the other charges, et cetera. And then another thing that I want people not to overlook is saying, hey, how can I save on the expenses once I get there? Yeah. Because I stayed at a resort when we just came, and I knew that the bill at the bar was going to be astronomical, right? Sure. $20 a drink, right? So the first thing I did when I got there, even before I ordered groceries, I ordered my liquor, right? I Uber Eats immediately because it's no longer Drizzly. Uber Eats does it all. I literally, let me get 2 bottles of this.
Right. Prioritize the sauce.
You got to prioritize, right? And now I'm able to effectively have fun on a budget because I was being thoughtful about how much money I was spending for the family.
Ross, good tips for anybody who's still planning some of those summer travel plans. Finance's own contributor, Ross Mack. Thanks so much. Appreciate it. Let's do a quick check of the markets here as we're taking a look at the major averages. The Dow above 40,000 intraday. First time we've seen that happen, folks. Ladies and gents, boys and girls, we'll see if we can hold on to it going into the close. S&P 500 and the Nasdaq, they're also in the green. That's it for Wealth. I'll see you back here tomorrow. I'm Brad Smith. Thanks so much for watching. Stay tuned. Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. You do not want to miss it.